Bismillahirrahmanirrahim. Uh, Assalamu alaikum wa rahmatullahi wa barakatuh. Very good morning, afternoon, and late afternoon, wherever we are based. Uh, it's indeed pleasure to welcome you all. And most of you I have registered, I think already logged in. So probably I will start with my short, not a presentation, but just some of the key points. And then inshallah, our discussion can commence. We are thankful to following institutions and their representative for their participation in this meeting. We have 50 institutions, including 10 regulators, and also from AOFI, IFSB, and ILM. And we'd like to thank our chairman, Mr. Khalid Hamad, for their participation. We also core working group members who worked hard with us, in particular, Brother Khurram, and also Brother Mia Nazir in particular. I would like to name all of them, but given the time shortage, I will keep it to few, and I hope others will not mind, and we respect everybody who are joining. IFM members, contributors to this consultative meeting paper, which we circulated. We have honorable few scholars who we invited, Sheikh Nizam Yaqubi, Sheikh Akram Laldeen, and Sheikh Aznan Hassan. We also have presence of Umar Ansari, Secretary General AOFI, also Dr. Rafki Ismail, Assistant Secretary General IFSB, representative of ILM, Sibafi, ISDA and ICMA, representative from IDB and ITFC, representative from Central Bank of Bahrain, Central Bank of UAE, Saudi Monetary Agency, Bank Indonesia, Bank Negara Malaysia, Dubai Financial Authority, Lavwan FSA, Monetary Authority Brunei, Bank of England, Central Bank of Philippines, and UAE Higher Sharia Authority. We have 27 Islamic institutions, including the international banks. And again, I will not be able to name all, so you will accept my apologies for that. We have representative from around 10 service providers, accounting firms, law firms, City UK, represented by Stella Cox. So these are our sort of consultative meeting participant today. And I'm sure others will also provide written comments, those who could not join. Normally, IFM would have organized this meeting in person, which we were looking into it, but alhamdulillah, we are able to now organize this virtual meeting. And we kept the time for about 2.5 hours. Subject, we all know, is very challenging, and naturally, it requires more than 3 hours or maybe entire day, normally we do. And I hope this is just a starting point for us, for the Islamic industry, to take things forward after this meeting. So I will just mention our objective, and naturally we have to be mindful that this is the beginning, and actual work, inshallah, will commence given the priorities which the meeting will establish. Please, we will also note that consumer is to tackle the implementation issues of global IBOR transitions to risk-free rates. And we will not be covering, that's another topic which generally in Islamic industry circles been often mentioned, and there is some roundtable and discussion has already been regarding the Islamic benchmark, but that's a separate topic and another challenges it poses to develop. So we will not be covering the Islamic benchmark rate. This meeting is just for the implementation of IBOR transitions to risk-free rates. We also have to be mindful that this meeting is just the starting point, and specific challenges and issues to be raised by the presenters today. And based on the recommendation, then inshallah IFM and other relevant bodies will take up the actual work which could be done by the various committees or working groups, which will be, I'm sure some of may have been formed and which will be formed also after this exercise. I again request that the paper we have sent, if you have some more suggestions, I received some feedback that maybe some others have some suggestions. or some solutions. So please do share with us after the meeting, and we'll be happy to update our basically consultative paper, and we'll try to make it in a more final form for the reference purposes. Although we have kept time for this meeting, the main objective of the meeting, if I may just very quickly go over, is to assess the impact of risk-free rates on Islamic transactions, which are basically all segments you can see: commodity muraba, sukuk, syndication, hedging, and other financing transaction, ijara, diminishing musharaka or musharaka, etc. So this is one thing which we have to assess in this meeting. Identification of remedies and solutions to tackle by IIFM after consultative meeting. That could be benchmark replacement, benchmark fallback, and guidance on language for existing and new contracts. That's the area of IIFM work. So we kept it for IIFM based on your recommendation to carry the additional work. We also developed Islamic structure and solutions by IIFM in coordination or jointly with other relevant infrastructure institutions. So we do very closely work, especially with IFSB and AOFI in particular. Development of develop global communication and benchmark protocols. Again, this could be IFM and in coordination or jointly with other infrastructure institutions which are in the Islamic financial service industry. Fifth, identification and consultation issues such as accounting and governance. We do have a good presentation, and it was included in the paper also from EY Bahrain. So tackle the relevant Islamic standard setting body governance issue or accounting issues by AOFI and IFSB in particular. The possible changes, we kept this topic for OIC domestic interbank benchmarks. So this could be something which we can have a brief discussion allowing if the time allows, or we can have something included in the paper if you'd like to share with us if there is some contribution to be given. And finally, we noticed when we were sort of carrying out this assessment exercise of this, this consultative meeting, that creating the awareness, especially in some of the Islamic institutions or jurisdiction may not be as robust as in some other jurisdictions. And that could be, the reason could be some markets are more cross-border and some are more domestic markets. But eventually, I think everybody maybe have to do some adjustment at some stage. We'll now start the meeting proceedings. Once we finish with the presentations, I will request the Honorable Sheikh Nizam, Sheikh Akram, and Sheikh Aznan to give their comments. So this exercise will not ready to seek the guidance, but general comments on this exercise. So we know the issues are such that those could be tackled at the actual development work and actual consultation, but their comments will be very helpful. For ease of productive discussion, as I said earlier, we have around 50 institutions, and some institutions have more than one. So we have 3, 4. So average, I think we have about 2 per institutions who are participating. And I'll be requesting that if one person can kindly coordinate, the comments and suggestions. And inshallah, we kept half an hour, but that, depending on your request, we can increase the timing as you may suggest to us. We do have a chat inbox as normally the case, and you can send your chat or your suggestions in the chat box, and my team will manage, with if the answer requires some feedback or on the presentation, some clarification, then we will arrange that with the respective presenter. The aim of end of this meeting would be, inshallah, to map or a roadmap for next steps to be taken. So at least, or some recommendation we have to take it forward. Some we already noted in our consultative paper, but I'm sure a number of you, including regulators, would be able to suggest certain things for us and also to prioritize. So this is basically to keep it realistic, that this is the starting point. We would like to have a roadmap which we can take forward, and we prioritize, and we see that we don't really lag behind when implementation actually in certain global jurisdictions start taking place. With that note, I would like to now request Alessandro Vaselli from Standard Chartered Bank to give his presentation, introduction to LIBOR and transition to risk-free rates. So may I respect Alessandro to please take over now. Thank you.
Hello, Ijlal. Good morning, ladies and gentlemen. Can you hear me?
Yes.
Okay, good. Can I ask you, well, first of all, thanks everyone for attending. I am going to talk about what's happening really and why are we transitioning to RFRs for about 15 minutes. And the topic has been researched very thoroughly, and there is copious amount of literature because working groups have worked at this for over 5 years, so it's not easy to summarize it. You will see a slide presentation, and we'll go through 11 slides together very quickly in the next 15 minutes. So let's see. Next slide, please. And next slide again. So yes, what is LIBOR? So this presentation may be a bit repetitive for some of you because it's just trying to set the stage and be informative on the basics of what has happened and what is happening, and to allow other speakers to speak about the impact on Islamic banking in more detail. So this is just really focusing on what's happening in the conventional financial world. So as we all know, LIBOR is the average interbank interest rate at which banks are prepared to borrow and lend to one another without the need to post collateral. And it determines the amount of floating rate payments over different tenors. So it's quoted across 7 tenors and also quoted for 5 major currencies. LIBOR is calculated on a trimmed average of submissions made by a selection of panel banks. There's 16 panel banks for US dollar LIBOR. And the submissions are computed using available transaction data, but in the absence of transaction data, panel banks can use their expert judgment. Can I have the next slide, please? So what went wrong? So there have been changes in the way the banks fund themselves, and these changes caused a significant decrease in transaction volumes in the unsecured interbank lending market, which is the market on which LIBOR is based. I mean, on an average day, if you're looking at 3-month LIBOR, the volume of funding transaction between major global banks is calculated to be at about 500 million and made of just 7 daily transactions. And this compares to approximately 200 trillion of financial contracts referencing 3-month USD LIBOR. So, I mean, the figures suggest that really LIBOR is a phenomenon where this kind of the tail is kind of wagging the dog. So intuitively, there is something that regulators want to change there. Also, at times of market volatility, LIBOR was no longer representative of the market. And I remember in 2007, I was supporting an origination unit in one of the American banks, which were directly affected by the financial crisis. And we couldn't originate. The bank couldn't originate anymore. Cash lending transactions because it couldn't source, although LIBOR was still quoted. So there is a disconnection there. And that is because LIBOR submissions, can be submitted on the basis of the expert judgment for panel banks and not actual transaction data. Finally, as we all know, there were high-profile rate manipulation cases involving LIBOR that required then changing the scene. Next slide, please. What is IBOR discontinuation? So first of all, what does discontinuation mean? So the Financial Conduct Authority in July 2017 announced that they would no longer compel panel banks to submit LIBOR quotations, although panel banks may continue to submit LIBOR rates beyond 21 if they wish to do so. And if we think about situations where of market volatility, then we can understand how a panel bank may be uncomfortable with submitting a quotation in those circumstances. So it is entirely possible that the discontinuation date for LIBOR will be at the end of 21. We should also bear in mind that in April 2020, following the outbreak of COVID-19, the FCA reaffirmed the timeline that they had stated earlier. So the lifespan of LIBOR is uncertain. Regulators are encouraging banks and financial markets participants to begin removing their dependencies on LIBOR and begin actively transitioning away from LIBOR by 31st of December. So why do we drop the L, of LIBOR and we talk about IBOR discontinuation? Well, that's because LIBOR is used as an input to calculate interbank offer rates in other currencies and countries. So there's some quoted there in the slide. So it's a wider phenomenon than London interbank offer rates. Next slide, please. So what's coming after LIBOR? So we have the new RFRs. Now, I'm not going to go through this table in any detail. The information is also available on the white paper that is being circulated and for this to participants to this conference. It gives you an overview of the the new RFRs, what they're called, who the administrator is, they're central banks, as you can see, and the fact that these RFRs started being published long ago. We see they've been available for a while. Next, right, please. Sorry, next slide, please. Okay, so in this slide, I'd like to take a closer look at the dollar, the US dollar. The reason being it's the reserve currency of the planet, and there isn't really, unfortunately, time in this presentation to go through each currency and their risk-free rate. So for dollar, the working group is called ARC, and it's a group of private market participants which was tasked with identifying robust alternatives to USD LIBOR and to supporting a transition away from LIBOR. There are 300 members now and non-member institutions that participate to the working group for dollars. ARC selected software as the rate that represents best practice for use in certain new dollar derivative and other financial contracts, and ARC and software is the preferred alternative to USD LIBOR. What is software? It's a broad measure of the cost of borrowing in the repo market. So it's borrowing cash overnight, and this is a form of collateralized borrowing, collateralized by US Treasury securities. So what are the advantages? Software is a much more resilient rate than LIBOR because of how it is produced and the depth and liquidity of the markets that underlie it. Software better reflects the way financial institutions fund themselves today, and it's calculated that transaction volume underlying software regularly are around 1 trillion in daily volume, $1 trillion in daily volumes. So this makes software a transparent rate which is representative of the market across a broad range of participants, and it is also protected from attempts at manipulation. Next slide, please. This table explains some of the key differences between LIBORs and RFRs, and again, I'm not going to go through this in any detail. It's available on the white paper. I guess on calculation methodology, RFRs are backward-looking and calculated on actual transactions. They're seen as more robust benchmarks because of the strong volumes and the fact that they use actual transactions, not submissions, which may rely on expert judgment. Regarding the term structure, as we know, LIBORs have an advantage in that respect because they're created with term in mind. And however, RFRs themselves, they're just, the raw RFR data is just a backward-looking overnight historical computation. So an RFR requires a calculation, requires market participants to make a step forward to something that I call here adjusted RFR. So it requires to be used in regards to floating rate payments. So RFR requires averaging or compounding to determine a cost of borrowing or financing for any period greater than 1 day. So there is an additional calculation that needs to be made there. Yeah, the next slide, you're already there. So in more detail, the fundamental thing to keep in mind is that in determining floating rate payments that are to be paid or received, sorry, I'm on the next slide. No, yes, sorry, I'm good. We're good. So in determining floating rate payments, the raw RFR overnight data will need to use some kind of averaging, and so to use RFRs, financial institutions will need to make two adjustments. One is called the term adjustment, which account for the move from overnight to a tenor, and most likely this will involve some form of compounding, but we'll see more detail later. And then a spread adjustment or value transfer. This is also a phenomenon known as value transfer. So looking at the numerical figure of your adjusted RFR and LIBOR for the same tenor, historically we're looking at a range where the RFR is lower than the equivalent LIBOR. So how do you adjust for that value differential in a way that in this case financial institutions are not at a loss? Well, for derivative products, ISDA has determined that upon a cessation of LIBOR, the spread adjustment could be based on the historical median spread between the relevant IBOR and the adjusted RFR calculated over a 5-year look-back period. And for cash products, ARC and the Sterling Working Group have recommended the use as well of 5-year median spread adjustment methodology to determine what does it determine? It determines a spread that will need to be added to your profit definition. In addition to the adjusted RFR value to come to a figure which is comparable to the current LIBOR levels. Next slide, please. So we said in the previous slide that we will need to have methodologies, we will need to make calculation to determine an adjusted RFR. So what do we do? What does a financial institution do? Well, first of all, you determine the period of time over which your floating rate needs to be calculated. And then there are 3 options fundamentally to calculate an adjusted RFR. The first is the daily simple in arrear calculation methodology. Second option is the compounded in arrear calculation methodology. And the third option is the term RFR in advance calculation methodology. Next slide, please. If you're looking at the in arrear calculation, what's the difference between simple average and compounded average? Well, first of all, ISDA has determined that the compounded setting in arrear rate will apply as a calculation methodology. However, if you're looking at financing, cash markets, loan markets, finance houses will need to decide between a simple or compounded average to determine the RFR, the adjusted RFR in arrear rate. In the short term, simple interest conventions may be easier, and we may have systems that are already set up to accommodate it. However, the opinion is that compounded interest would be a more accurate reflection of the time value of money, and this would be more important as interest rate, very important consideration as interest rate rise, because it allows for more accurate hedging and better market functioning. Another important point to mention here is that if you look at the numerical difference between simple average and compounded average, typically it's about between 0 and 10 basis points over the last 2 decades. So it's not a huge amount. That's on dollar the dollar RFR, so SOFR. However, the difference between the two starts becoming larger if interest rates move higher, or if the payment frequency of your tenor, which you're trying to calculate, is longer. The Sterling working group in that has identified that the use of compounding calculation to determine an adjusted RFR that an institution can use can create difficulties in some product areas and client segment. So typically, these are listed here. Obviously, I would mention Islamic finance because intuitively, a compounded in arrear calculation may have conceptual difficulties. I looked at the formula that I think that is published, and I couldn't really understand how the calculation for compounded average in arrear is. It has a really nice uppercase pi, the Greek letter pi, but I don't really understand what that means. I understand the simple average one, which has a uppercase sigma, which is interesting, but not a compounded one. So I cannot expand any further. Over the next slide, please. In this slide, we just have some terminology, which is going to be useful for the rest of the day as well. So what happens is that with your raw data that you obtain overnight every day, you compute your adjusted RFR, but the numerical value of the RFR will only be available at the end of your calculation period. So it provides very little notice before the payment is due. So what are the options? So there are 3 options. The first one is payment delay. So you average your daily RFR or overnight RFR over the calculation period, and you simply make the payment n number of days after the start of the new calculation period. Then the second option is a lockout or suspension period. So you use your average RFR over the current calculation period. However, the last overnight rates are set at the RFR rate observed n number of days before the period ends, typically 2 to 5 days, and that is repeated for the 2 to 5 days lockout period. And the third option is the look back option, which seems to be the popular solution. I hear that more and more. So for each day in the calculation period, the RFR rate used is the one observed n number of days earlier than that day. And typically the look back is 3 to 5 days. Next slide. And this is the final slide. So we're carried through the presentation, but I think we kept to the timing. So this is a very brief glance at term rates in advance, and obviously this could be a good solution for cash markets and for Islamic banking, in that it would make available benchmark data ahead of the calculation period, like we're accustomed to seeing. In the slide, you have a progress report, because at this stage, the term rate for sterling, Sonia, seems to be a leader in respect to timing, and we're expecting publication of the term rate in December of 2020. All the other term RFRs are work in progress. For the dollars, you're looking at a term of the end of the first half of 21, and so on and so forth. there is information on this particular subject matter in the white paper as well, if you want to look into it in more detail. I just wanted to make a couple of points here. The first one is the administrator for the term rate is going to be someone in the private sector. Is not going to be a central bank like for the overnight RFR, and also the data and the calculation methodology for these term rates is not just going to be your overnight RFR, but it will use complex calculation, which will include also futures and other market data in addition to the overnight RFR. This concludes my presentation, Ijlal. Thank you very much.
Thank you indeed. Once again, Alessandro, it's very helpful in terms of, especially I think your last slides, although all information is very helpful, looking at how the rates are being sort of calculated, and we have to sort of see, in the Islamic, to be aware of how those calculations are done, especially the compounding. In some cases, in our we have some issues also, so we have to see that. Alhamdulillah, I think we can move to next, and we have most of the participants. So it's about 128 participants you can see, and we have 10 jurisdictions who are participating. So once again, I'm really honored from IIFM that all of you are alhamdulillah joining, and I look forward to after presentation some constructive discussion, and inshallah this information and planning will really help us. We'll move to now Mustafa Adil, Refinitiv. They previously also had a great role in terms of managing the rates, and going forward also there will be a role, although now mostly the regulators are taking up some of the responsibility, but I will not go in more into that. I will request Mustafa to please give his presentation, and inshallah over to you.
Thank you very much, Brother Al-Jalal, and Assalamu alaikum, everyone. I hope you all can hear me, and we can start with the presentation if you can share the... So basically, my presentation is going to be very, very short, and I'm going to tackle three main things. I'm going to talk about the proposed regulators for the new RFRs. I'm going to talk about administrators, and I will give a high-level overview of the timelines. So if we start with the first slide, as Brother Alessandro mentioned, the LIBOR rate was homogeneous across the 5 different currencies because it was managed by a single regulator, the FSCA, and it was administered by a single benchmark administrator, which was the ICE, the Intercontinental Exchange Benchmark Administration. Now, what you have with the new risk-free rates is that you have multiple regulators for these rates. You have multiple different working groups, and each one is working to a different timeline. So this is going to be fundamentally different from what was previously available with LIBOR. Now, when we look at the rates being issued, there's essentially 3 different types of rates. The first one is the RFR, the core RFR, which is the overnight rate. And primarily, different institutions different working groups are looking at different types of rates. Some are looking at deposits, some are looking at repos, but essentially they all agree that the overnight risk-free rate is the way to serve as the primary basis for the different rates in question. The second rate, which also Brother Alessandro touched upon, was the compounded rate. Now, the compounded rate is a term rate. It does look at, 1 month, 3 months, 1 week, whatever the term may be, but it is historical. It looks at the compounding of the investment over a historical period using the overnight rate as the basis. Now, both of these 2 rates are going to be issued by the working groups and will be under the supervision of the respective regulators. So both of these groups will not have a private administrator providing them. The rate that will have a private administrator providing it is going to be what we're calling the forward-looking rate. Right? And the forward-looking rate is where really you try to project and see what the risk-free rate is going to do into the future. Now, you have multiple tenors for the forward-looking rates, but the key here is that this rate will be managed by private administrators. So you will have private benchmark administrators managing these rates. Now, the other interesting thing that I would like to mention is each working group is taking a different approach as to how many administrators are required. So if you look at the Sterling Working Group, they have decided that they will have multiple benchmark administrators providing the forward-looking SONIA term rates. And the idea here is that competition will increase the service and the quality of the published report. The Japanese working group has already stated that they will have a single administrator. They don't want multiple administrators. They will have a single administrator that will publish a single rate around these different tenors. The other three jurisdictions, the US, Euro, and the Swiss, have not at this point declared which direction they're going to go in. They're still waiting and seeing, and it could go either way. They're still debating within the working groups what is the benefits of each approach. Now, within this, the most advanced is the Sterling Working Group. And if we move on to the next slide, currently there are 3 different benchmark administrators that have approached and have been approved by the regulator to provide rates for the term SONIA, the forward-looking term SONIA. They are IBA, which was the previous administrator for the LIBOR rates, and they are FTSE Russell. And each of them have multiple tenors that they're providing. They have different methodologies, but there's a lot of alignment. And the primary focus here is that you take the overnight rate as the primary basis for your calculation. And then what you do is you look at the OISs that are in the market. And by OISs, I mean the overnight index swaps. And you use those derivatives to determine what you expect the term rate to be. Now, the key difference here between the LIBOR is that whereas LIBOR was contribution-based, this is going to be purely transaction-based. So you have to have executed transactions around these derivatives for it to be considered in the calculation. And this is a major fundamental difference between the LIBOR calculation and how we're calculating the forward rates here. The other key thing that I would mention is that, again, as Alessandro mentioned, the forward rates do not factor in credit risk. They're only looking at the term in question. So you have to allocate a spread between the forward-looking term rates and what was historically LIBOR. And what is interesting is, if you look at these rates, and these have been published for the GBP since July this year, if you look at these rates, the spread is relatively small when you look at smaller tenors like 1 month or 3 month. But as you go to 9 months or 12 months, the spread increases significantly. And that is something that the working groups are looking at, and they will give some kind of recommendation to institutions on how they should be tackling that going forward. If we move to the last slide, I just want to talk very quickly about the relative timelines that we're looking at. So far, only 3 different working groups have disclosed their high-level timelines on how they intend to approach this. And the most advanced is the Sterling Working Group. So since July of this year, 3 different benchmark administrators have been issuing what we're calling prototype rates. And these are publicly available to all market participants who can see and review them. In September of this year, basically what was instructed by the regulators that lenders must not offer the GBP LIBOR linked loans to customers. In December, we are expecting the regulator to approve the prototype rates. So those prototype rates can then be used in transactions going forward. And from March of next year, the timeline is expected that no new loans issued can reference the previous GBP LIBOR within the UK jurisdiction. And this is a major thing. So although the LIBOR production will not be guaranteed from December, the regulator is mandating that from end of March 2021, no new loans should be referencing GBP LIBOR. Only the previous loans or the previous transactions that are continuing to run can continue to work on the LIBOR that is being published up until a point where an alternative or transition mechanism is created for them to transition to one of these new term rates. When we look at the US working group, they started the process of defining and creating the term for the reference rates in July. In October, they issued the RFP for different private administrators to submit their proposals for how they would structure the term rates in the US. The SOFR term rates are expected to be published towards the H1 of 2021, but this is conditional on there being enough liquidity in the derivatives market in terms of OISs to be able to calculate this rate. The working group is emphasizing very, very significantly that it has to be based on transactions and not based on estimations or submissions, right? And that is a key caveat that they have inputted, and it's also a key caveat within other working groups as well. And then if we look at the European working group, they are still going through consultations as we speak right now. Their RFP has not been issued. It is expected to be issued sometime in Q1 of next year. And this RFP is going to be what invites administrators, and this is when we will know if a single benchmark provider or multiple benchmark providers will be considered, and they're expecting publication of the rates to take place in Q3 or Q4, again, subject to sufficient liquidity in the market. And for all the different rates, LIBOR production will no longer be December 2021. Again, this does not mean that LIBOR will cease to be produced, but the guarantee will not be there, and no regulator will allow any new transactions to be linked to the previous LIBOR. And they're pushing very heavily for existing transactions that will continue to run beyond 2021 to have a plan to transition to one of the new term rates. I think with that, my presentation concludes, and Ijlal, I'll hand that back to you.
Thank you, Adil. Indeed, a very helpful presentation, and looking at the timelines and all, some are approaching. I was reading this morning also that there could be some delay in the transition and secured overnight financing rate, because how the terms rate will be established. So there are still challenges, but I think overall, if we are starting now, inshallah, in Islamic industry, and we move quickly, we'll be able to really, in terms of the broader transactions, able to, inshallah, find solutions and the required documentation and guidance also. We also now have Paul Richards, honored to have him from ICMA. He will be presenting our risk and regulations, or rather talking and more on the specific to the bond market, which we can use as a reference since we have Sukuk market, which is a very active market. And I think this will be also helpful. We do have also with ICMA long-standing MOU, and we sometimes share and we are really honored to have him. And we'll also see if there could be some later on, some joint work can be done to improve our industry. So Paul, over to you.
Thank you very much, Chairman, and thank you for inviting me. Can you hear me?
Yes.
Good, thank you. I'm going to talk briefly about the transition from LIBOR to risk-free rates globally in the bond market, and I'm going to focus on three issues: progress in the transition in the bond market, the regulation of the market, and the risks that need to be addressed by market participants by preparing for the end of LIBOR. I should say at the outset that I'm chairing the risk-free rate bond market subgroup in London, working closely with the Bank of England and the FCA. The FCA, as you know, has an international role as the regulator of the administrator of LIBOR, and contracts referencing LIBOR under English law are denominated in a range of different currencies, particularly sterling, but also predominantly US dollars. As you know, LIBOR is due to cease on or after the end of 2021. My first point is about the global transition in the bond market. The starting point for the transition is for market participants to use risk-free rates instead of LIBOR in new financial transactions. Substantial progress has already been made in using risk-free rates in wholesale markets internationally, including in the sterling and US dollar bond market. In the sterling bond market, referencing SONIA, new issuance referencing LIBOR has all but ceased. New issues in the bond market are generally using risk-free rates compounded in arrears rather than forward-looking term rates. And both the Federal Reserve Bank of New York since March and the Bank of England since August have been publishing daily compounded indices for SOFR and SONIA respectively. The transition to risk-free rates for new transactions leaves a tail of legacy bond transactions still referencing LIBOR and maturing beyond the end of 2021. The FCA is encouraging the market to reduce the legacy tail through active conversion from LIBOR to risk-free rates before the end of 2021, or to introduce fallbacks from LIBOR to risk-free rates where this is practicable. As risk-free rates are economically not the same as LIBOR, a credit adjustment spread needs to be added. In the case of fallbacks, the cash markets have adopted the same method of calculating the credit adjustment spread as the derivatives market, the historic median over a 5-year look-back period, as Alessandro said earlier. Unlike the derivatives market, a multilateral protocol is not feasible in the bond market. Active conversion from LIBOR to risk-free rates in the bond market needs to be carried out bond by bond. Most legacy LIBOR bonds in sterling or US dollars fall back to a fixed rate when LIBOR ceases, which was not the original intention. Some bond contracts are too difficult to convert, and there are also too many to convert by the end of 2021. My second point is about regulation through legislation of tough legacy contracts. There will be an irreducible core of tough legacy contracts outstanding at the end of 2021. The UK authorities are proposing to legislate for tough legacy. At pre-cessation, which is potentially at the end of 2021, when the FCA judges that LIBOR is no longer representative of its underlying market, LIBOR will no longer be permitted to be used in new transactions, but it will continue to be used in certain legacy transactions. And in response to its international role as the regulator of the administrator of LIBOR, legislation was introduced in the UK on the 21st of October to grant the FCA powers to direct the administrator of LIBOR to change the method of calculating LIBOR when it's no longer representative from a panel of banks to a different method. And last week, on the 18th of November, the ICE Benchmark Administration, the administrator of LIBOR, announced that it will consult on its intention that the Euro, Sterling, Swiss franc, and yen LIBOR panels will cease at the end of 2021. And alongside this statement, the FCA published 2 consultations about its proposed policy in relation to the new powers that it'll be granted by the legislation. The interaction between legislation in the UK and legislation also proposed in the US and the EU is still uncertain. It would make a big difference in the international bond market if the legacy rate for US dollar bonds under English law and the legacy rate for US dollar bonds under New York law would be the same. Now, my third point, Mr. Chairman, is about avoiding risks by preparing for the end of LIBOR. On the 16th of October, the Financial Stability Board Official Sector Steering Group, as the global standard setter for the transition from LIBOR to risk-free rates, published a global transition roadmap setting out ways in which private sector firms can minimize risks by preparing for the transition away from LIBOR, and noted that individual regulators may require firms to move faster in some instances. The steps include the following. Firms should already, at a minimum, have identified and assessed all their existing LIBOR exposures by currency and maturity beyond the end of 2021, and the fallback arrangements that those contracts currently have in place. Firms should have identified other dependencies on LIBOR outside of its use in financial contracts, for example, use in financial modeling, discounting and performance metrics, accounting practices, infrastructure, or non-financial contracts, such as late payment clauses. Firms should have agreed a project plan and should have begun communicating with their clients about the transition. Firms should adhere to the ISDA fallbacks protocol, subject to individual firms' usual governance procedures and negotiations with counterparties as necessary. Adherence to the protocol is strongly encouraged by regulators, and where the protocol is not used, other appropriate arrangements will need to be considered to mitigate risks. And providers of cleared and exchanged traded products linked to LIBOR should also ensure that these incorporate equivalent fallback provisions as appropriate. By the middle of 2021, firms should have determined which legacy contracts can be amended in advance of the end of 2021 and establish plans to do so in cases where counterparties agree. Where LIBOR-linked exposure extends beyond the end of 2021, firms should make contact with the other parties to discuss how existing contracts may be affected and what steps firms may need to take to prepare for the use of alternative rates. And firms should have implemented the necessary system and process changes to enable transition to robust alternative rates. By the end of 2021, firms should be prepared for LIBOR to cease. All new business should either be conducted in alternative rates or be capable of switching at limited notice. And for any legacy contracts for which it has not been possible to make these amendments, the implications of cessation or lack of representativeness should have been considered and discussed between the parties and steps taken to prepare for this outcome as needed. The scope and impact of any steps taken by the authorities to support tough legacy contracts, if available, should have been clearly understood and taken into account. And finally, all business critical systems and processes should either be conducted without reliance on LIBOR or be capable of being changed to run on this basis at limited notice. Thank you, Mr. Chairman.
Thank you very much, Paul. It was really very helpful to note, and also the deadlines, and also especially from IIFM perspective, since we predominantly deal with the contracts and documentation, to see the amendment, which in some cases in Islamic also we know. And I basically just forgot to, in the beginning, mention that when we did our sort of work for most of the hedging contracts, which are now widely used with ISDA, at the contract level, we don't have really, any issue to amend our main master agreement, the Hawad agreement, or the product confirmation for foreign exchange or profit rate swap or cross-currency swap, or neither credit support deed. But at the execution level, naturally, there are things which we have to look. And I think you are also rightly pointing out in that regard. So it was really very helpful, to note what you have presented and for us to learn. We have in the chat box some chat. If you, Paul or Alessandro or Mustafa, want to take up after Habib, maybe we can just, because I would ideally like to basically cover more on the Islamic, the solutions, which could be the later part of this session. But there are few chats I saw in terms of the liquidity and how secured overnight financing rate, there is a query. So if you can kindly check the chat, and after Habib, if somebody want to, any of you just, please, before we go to the next one, on the accounting side, we will basically, I think I would ideally like to basically cover in terms of the IBOR related or risk-free related queries. There are two queries. If you can kindly look into this, and then whoever wants to please take it up, just let me know after Habib's presentation. So thank you. With that note, I would like to now invite Habib Mutani. We have been working for many, many years now, and we developed one segment which Habib greatly contributed. He is also sort of representing ISDA also in terms of our work, and his sort of in the paper there are some slides, but I'm sure he will basically like to cover more in this presentation and some of the key issues, and I would, if I'm correct to say, more to do with Islamic industry, what can be done. So Habib, over to you now.
Thank you, Ijlal. Bismillahirrahmanirrahim. Assalamu alaikum, everyone. Can you hear me okay? Yeah, okay. All right, fine. So if I could have my slides, perhaps. What I want to do is you've been hearing, and in the later part of this session, you'll also hear further about some of the new or alternative rates that are being developed. In addition, and of course, a lot of the focus that we have is on future transactions. So how will people transact going forward? If I could have the next slide, please. What I want to do is recognize something that Paul mentioned in his session just now, which is that there's potentially a lot of existing transactions that are still going to be alive at the point of transition. And the question is how best to deal with those. And again, as you heard from Paul, there's also some regulatory impetus about how to deal with those, or dealing with those effectively as well. Many of you will be aware of the ISDA protocol. And a protocol, as you know, is an efficient tool to deal with contractual amendments between multiple parties. So that's something that ISDA, particularly in the derivatives market, has been developing, not just in this particular case, but actually there's a history of protocols which ISDA has managed and produced for the benefit of the market. And so there's been some discussion about whether a protocol approach might be possible here too, and that's certainly something that we should all consider. And I thought what I would do in the next few minutes is just pick up on a few things that people need to take into account and think about if they're looking at developing a protocol in order to have a successful protocol. So in a sense, what are some of the potential pre-requirements if you are going to go down the protocol route? And perhaps the most obvious point is that you obviously need agreement on, or a consensus on, a number of things. Clearly, what rates you're going to use, the protocol is going to apply to. But perhaps even before that, one basic question is what agreements are going to be covered by the protocol? And that's not an entirely straightforward question, because what you also need to take into account is the different products that are out there where LIBOR rates or IBOR rates are being used, and therefore potentially needs to be subject to some sort of amendment. So for example, we see the ISDA protocol is largely directed at derivatives transactions, and other sales and trading transactions as well, so other sales and trading documentation. But it isn't, as Paul mentioned, it doesn't apply to Sukuk, it doesn't apply to loans. And this is something to think about, because one of the aspects that's important to deal with or address is the alignment between products. So we know that, for example, use of the TMA is for hedging arrangements. So if you do have hedges for Sukuk, if you do have hedges for loans, you know, it's important to establish how you're going to align between those in any changes that you make. And indeed, if you're not going to align, and that may be the case, how best to address that. So I think that's one of the probably the sort of, you know, the key areas on which some consensus of approach is going to be necessary. As I said, what rates the protocol would apply to, what the trigger events would be that would bring the protocol's provisions into action in relation to the particular rates. We had some mention earlier on of cessation events and pre-cessation events. I won't go into the detail of that, but it just illustrates the fact that when an event has happened in relation to a particular rate, which should result in the new rates or alternative rates being applied, is something that needs to be discussed and agreed on, and you need an element of consensus on. Obviously what the new rates should be and who should determine them is important. And again, we heard something about the potential providers of rates the risk-free rates themselves, largely central banks, but actually if term rates are to be used or forward-looking rates are to be used, how they should be determined and who should determine them. There's a question of sufficiency of contractual amendment. What do I mean by this? I think it's important to see something like a protocol as part of an overall strategy. It's not something that by itself will get you from where you are today to what the new world is likely to look like. Because in addition to amending contracts or putting new contracts into place, there's a whole strategy of communication, agreement, and so on. So I think it's important to see the protocol as really one part of an overall strategy. And even from the pure contractual perspective, there may be more required than something that a protocol potentially can achieve just because of what it is. So you'll have seen in some of the papers ideas about structuring transactions slightly differently from the way they historically have been structured, or at least some transactions, for example, additional murabha, maybe additional wired, and so on. If you're going to do those sorts of structural changes, it's going to be difficult to achieve all of those purely via protocol. So again, exactly how you need to play out your transactional changes needs to be thought through, and a protocol may well help in achieving some of that, but there's probably going to be steps that are necessary alongside something like a protocol. Next slide, please. You also need to give some thought to the universe of counterparties that potentially will use the protocol as a tool. Obviously, for it to be worthwhile, you need a decent amount of anticipated take-up. That doesn't have to be everybody, almost certainly won't be everybody, but nevertheless, I think there needs to be some consensus and comfort that there's going to be an adequate amount of take-up from the counterparties. And again, that goes back to the strategy point, because really the protocol is something that comes after a great deal of discussion in terms of market consensus and building market consensus, so that by the time the protocol becomes available, there's already a significant amount of buy-in to that approach as a way forward. And things to think about in that context are the whole communication exercise with clients, a recognition, as a number of others have mentioned, that changes to rates are likely to involve value transfers, how you're going to deal with the value transfers. We talked about the potential need for changes to structures of some transaction, again, how you're going to deal with those. Recognize that something like a protocol is a public document because parties sign up to it, and who has signed up to it is visible. That's part of the methodology for its operation. And there are inevitably going to be, I suspect, some parties out there who aren't so keen on having their participation in transactions rather than the protocol itself made public, so they may be reluctant to sign up. So all of those things are things that need to be thought about, and how to address those and how to deal with those needs to be given some thought in order to ensure that a methodology like a protocol can ultimately be successful. Contracts often involve other parties than simply the two contracting parties, in the sense that you often have security in structures, you often have agents and brokers, you often have trustees. Again, how to build in changes which, not necessarily in each individual protocol, but how you set up the structure so that other agreements like security provider consents, for example, trustee consents, have all been put in place by parties when they're signing up to protocols in relation to the relevant transactions, is something that will again need to be thought about. And particularly, again, as I say, if some sort of changes to structure are required, then that's something that also needs to be built in beforehand. And you'll see, if you look at the ISDA protocol, and this is similar, for example, to the TMA itself and the representations in the TMA, that parties signing up to the protocol give assurances that they have obtained the necessary approvals that they need in order to sign up. So again, people need to be able to go through that process and have made the necessary arrangements in order to achieve that. And again, where more parties are involved, that may be a certain amount of work and timing involved in that. Sharia approvals is obviously important, and not just in relation to the protocol itself, but obviously the changes to the underlying transactions that will be involved. Again, the approach taken, for example, with the TMA is parties are responsible for their own Sharia approvals, and they give a representation that they have obtained them. You know, that is a process that people will need to ensure they have gone through, in addition to getting comfort that the protocol itself is something that from their own Sharia approvals perspectives has been addressed and dealt with. There are regulatory aspects involved in this whole exercise. Again, we've heard of some of them. For example, the regulators mentions regarding requirements regarding timings, but it is a wider perspective than that. Individual regulators may have their own requirements on the firms that they regulate. And of course, the market consists of firms subject to different regulators. So it'll be important for individual firms to establish their own regulatory requirements that apply to themselves and accommodate those. But there will be things like, for example, ensuring that the client communication requirements and principles that individual regulators may have are being observed. That's a wider point, equally, in the sense that, especially with things like value transfers, individual firms dealing with their customers will want to ensure that their customers are clear what it is that they are looking to sign up to, how it will affect them, and their own decision making regarding signing up, so that the firms can be comfortable that their customers have taken proper decisions after proper consideration, especially taking into account things like potential value transfers. And then dispute resolution is something that will be important. You know, it's quite possible that there will be disputes arising, and it'll be important for the market to agree approaches, I think, as to how those will be addressed, who will address those, and that, that may depend on the individual types of disputes. Obviously, one would want to encourage parties to resolve them directly themselves, but there may be some elements of decision-making required, and some consideration should be given to how those should be addressed and whether the protocol should have any provisions in it, if there is to be one, regarding something like that. And then finally, it's worth mentioning that having a protocol does involve some infrastructure, and that infrastructure requires to be developed, managed, and does have a cost attached to it. So again, that needs thinking about setting up a site, managing a site, operating it. All of that requires a certain amount of resource. So I think a consensus will be required as to how best to manage that and operate that, and indeed pay for that. So those are really some of the things that I think the market needs to think about in the context of looking at the idea of a protocol as part of the toolbox in this overall strategy to dealing with the transition projects that individual houses will obviously be undertaking. Thank you very much, Isla.
Okay, Habib, thank you so much. It's been really helpful. As I said earlier, there are a few questions if somebody wants to take up. One question I can see is on the system requirement and the new rate. If Habib want to briefly say, but I think this question basically would be more to do with the, the solutions we are discussing and to be taken up. Right now, we need to develop these solutions and the best Sharia solution. So I think this question, you have seen, Habib. So if you want to have any comment or further, or
yes, it's really to make the point again that I agree that there is a systems requirement. That was the point I was making when I was talking about the infrastructure that would be required. I'm not the best person to speak to on the sort of technical aspects of that, but it's undoubtedly a question, an issue that if a protocol is going to be helpful, that obviously is one of the things that needs to be considered and ironed out.
so that could be, the priority work to be done when solution is agreed from the standard setting body point of view, one or two solutions which eventually, based on recommendation and the best Sharia guidance we can obtain on that to inshallah develop. The other questions, if you may have seen, if anybody, Mustafa, I think will take it up.
Yeah, exactly. Thank you so much, Idlal. And that's the question around liquidity, right? So the only thing that I can mention is that, till date, since July till now, we've never had a situation where the liquidity breached the minimum standard required. Now, currently, of the three administrators, only one administrator, IBA, has disclosed what that liquidity volume should be. Unfortunately, Refinitiv and FTSE Russell, due to certain market activities, potential acquisition of Refinitiv by the parent company of FTSE Russell, which is London Stock Exchange, there is certain legal feedback that we cannot disclose certain items in public because of that reason. But the IBA has disclosed their minimum volumes, and that is $250 million worth of trade required. And till date, from the start of the issuance of these rates in July till now, we've never had a situation where the volumes have declined to below that level. So you can use that as an indication. Unfortunately, we don't disclose exactly what the total volume was, but as a minimum, the volume has never declined below 250 million pounds, sorry, not dollars, below 250 million pounds. And the only other thing that I would say is that on the methodology for all three administrators, we have mechanisms to disclose outliers. So IBA, they don't take the anything in excess of the top 75% percentile and anything below the 25% percentile. Refinitiv and FTSE Russell, we take the median rates as well, so that we don't deal with the outliers. But I hope that addresses the question.
Thank you very much. And I think the other one also in the similar line. So probably very quickly because we have a lot to cover. So I think the other one.
May I ask
Yes.
a question?
Yes, please.
Yeah. Assalamu alaikum, everybody. And my question is that most of the, as the risk-free rate is backward looking overnight deposit rate. So when it comes to the Islamic finance, most of the Islamic finance products is determined at the spot point. How you are going to calculate the cost of the Islamic finance products?
Yes, I have noted. I think you are sort of jumping. This is, the exercise. I've seen another question that what the timeline and how IFM will do. These things take time. We are just doing consultation at the moment. How it will be done, what solution we take up, all that has to be done. So it's the starting point, right?
Yeah.
So we note it, but I think at this time, I think we rather not talk about this. In the end, we might, but at the moment, this meeting is not about really finding the real solution, is just to identify, make a recommendation and do further work. So this is what it is. Even the protocol, the question comes, how long IFM? These standards take time, but we are trying to do our best with the industry, with the support. Mashallah, all of you are joining and we can proceed, inshallah, quickly.
Thank you very much.
Of course, we have to see the Sharia solution. That's why we have few scholars. We didn't invite many because this is an exercise which has to be done when the actual works one, we seek guidance and all with them and all. That's our exercise to develop standards or the banks do it. So I think this is
the another note is the calculation of risk-free rate, which you said it will be like based on compounding average.
I think at the moment we will not go into that. Otherwise, we will not have any time. So with by due respect, we rather move to the Islamic, hear what the solutions are, what the problem, and then later on. We can have another consultation if required. We can have, because this we cannot really achieve today and we are moving without break. So I can see some people, but I think better we move without break. Mashallah, we are in own surroundings, so we can, drink or we can have a little break and while listening. But all these questions you can say in a sense, but these are the things which we have to tackle as we go along. This meeting is all about, taking as much, recommendation, as much as suggestions and all, and see how it will work. So it's not going to result into, finding solution. It cannot be done in one day. Conventional industry has worked for a year or more to develop. So naturally, we have to also.
I agree with you. I agree with you. But the problem is the risk-free rate when it comes to the definition of.
I think at the moment, I will request that we keep this question out at the moment. Whatever the solution, we will see the solutions in the end. And then further work, we can have a discussion. Otherwise, this meeting cannot end. So I'll really request that at the moment we just stop here.
Brother Ijlal,
I
suggest that any questions can be written in the chat. It's better than.
Yes, so we are not really opening the discussion. At the open discussion we can do, but my humble request is that we will be concentrating on the Islamic side and see how it will work without going into much details. Those details we cannot address in one meeting or one sitting. Each one has to be do with each committee or working group and all. If you all recommend, we will have another meeting to specific subject and try to understand more. So this is my humble request at the moment, that we just keep it into that. Then there is also, from UAE also question coming in about AOFI compliance and all. So these are all questions which we naturally have to be mindful how we work. This meeting, we will just, are seeking recommendations, we are seeking suggestions, we will note that, and then we do the further work. So we will not be able to, I think, justify, because itself the risk-free rate will take hours to discuss. Our aim is to at least move into some level where we can start some things. We have not done much in many cases, as far we have noticed. So this meeting is all about, learning and hearing from our respected presenters, and then have some brief discussion and see the solutions which will be presented today, which is an important session. We kept only half an hour, but that can take longer if you all agree at that time. So with that, my humble request, we just move now. If I may request now from Ernst & Young, they are Also, you question about AOFE. So naturally, AOFE is part of our exercise. And what they have presented in the paper, you can see certain things in the paper, and certain things we can improve in the paper also, because that paper itself, what we circulated, is in the draft form. So naturally, we're seeking comments on that and to further improve it and make a final paper, which could be our white paper used by the industry. So they have, have given us a good, write-up in the paper, good contribution, which I understand also involves AOFE also in that work. So I will now request Muzammil. I think you are probably, presenting on that one. So I will hand it over to you.
Assalamu alaikum. Bismillah ar-Rahman ar-Rahim. If I can, I'm aware, I'm conscious of the time, and I'm also very keen to hear the scholars and EOFI also. So I'll try to wrap it up as quickly as possible. Please move on to the next slide.
See, this is the question, Sheikh. This gentleman is basically, he's the one who wrote that Arabic.
So
this is the problem. We cannot entertain
yeah. Brother Iflah, shall I continue? Yeah. So as part of this exercise, we have as EY, this is not an official EY position, because for this platform and for the stakeholders that are present on this platform, we need a lot of inputs from all of them, and this is an ongoing issue. It will develop as we receive feedback from everyone. So. And especially input from Sharia and AOFE is very important. However, as part, we have submitted a detailed draft consultation paper highlighting several accounting matters. And while doing that, we have drawn references from IFRS, especially the ISB pronouncements that have been issued as part of phase 1 and phase 2. And we also looked at certain AOFE standards, both Sharia and accounting. And also we have read certain research papers that were available out there, and also some of the EY technical guidance, which is also available in public domain. So any one of you who is interested to know more what EY's point of view is, you can always, look at that. Please move on to the next slide. I would just like to highlight very quickly what the ISB has stated in this regard. So they issued 2 technical releases. First one is applicable for the year 2020. It basically tackled the issue around hedge accounting and hedging instruments, whether those would be effective, whether any changes to the documentation needs to be carried out. Because of the change in the underlying reference rates and the change of cash flows. And the second pronouncement by ISB was basically very recently. It carried out certain amendments to IFRS 9 and IAS 39 and certain other standards also. But for the purpose of this forum, I think changes made to IFRS 9 and IAS 39 are, and also IFRS 7, which is around disclosures, is very important. It also provided ways when it mainly talked about because of the change in the cash flows, and why the change in cash flows, because of the change in the discount rate by applying the new reference mechanism, or because of the change in contractual stipulations. If there is a change in the cash flows, what are the ways that those cash flows would either result into a derecognition of a financial instrument, a financial asset, or a financial liability? And if that derecognition is happening, then what are the special concessions, that an entity would apply so that a derecognition is not carried out, rather than, what kind of accounting treatment, especially charge to P&L, can be done. So practical experience, as we call it, or special concessions, have been highlighted in these 2 ISB pronouncements. It is very important that we look at that, because many Islamic banks, they follow IFRS, while other Islamic banks, they also apply IOFI. So while IOFI guidance is also important, and IOFI, I believe, is also going to highlight some of the relevant areas with respect to governance, with respect to Sharia and accounting as we progress forward. So but it is very important that we understand what ISB and IFRS has basically said in this regard, and all of this has been highlighted in the paper that we have submitted. I just want to identify the key themes that we have noted down in our paper. Moving forward, please, in the next slide. Move on, please. I'll skip this slide. I think the most important thing that the ISB pronouncement has said that if the change in the cash flows happens because of the change in the underlying reference rate, it could trigger derecognition. If an entity can justify and document and disclose that because the derecognition or as a result of the change in cash flows is not because of the change in the risk profile, in the credit risk profile of the counterparty, it is because of the change in the reference rate. Then the entity can take advantage of the special concession or the practical experience, as we call them, provided they are able to meet certain conditions. And those certain conditions are that the change in the cash flows as a result of the change in the discount rate is as a direct consequence of the IBOR reform. And also they have introduced a new terminology, which is economically equivalent. So determination of cash flows based on LIBOR or the previous regime and the new alternate reference rate, the result of the cash flows, if those should be economically equivalent. And one of the ways, they have not defined what economically equivalent means, but they have given some examples that in the new reference mechanism, for example, insertion of a spread, a credit spread, and then probably reaching to the same conclusion. So the entity has to demonstrate that the two calculations are economically equivalent, and in that case, they cannot derecognize the financial instrument. They can just record the change in their P&L. So that could be a profitability impact. And it is mostly going to impact the instruments that are recorded at amortized cost or which are designated at fair value through comprehensive income, mainly the loan contracts and the hedging instruments. Moving on, we've also highlighted in our paper that what kind of guidance we need to refer to for applying this context to the Islamic products or the Islamic contracts. So for example, I'll quickly highlight that in the new AOFI framework that is just about to be finalized, time value of money and discounting and substance over form has been described in more detail. It may not be completely relevant in applying these concepts for discounting or ascertaining the cash flows. Also, we have also highlighted that what could be the likely impacts on the Islamic contracts, given that certain contracts are of executory nature, while certain contracts have already been executed. So in this regard, what could be the likely impact? And lastly, Mudarba, Musharaka and certain agency type contracts, what could be the likely impact if the reference mechanism is moved from LIBOR to a new alternate mechanism. Moving on, next slide, please. In this table, we have summarized the implications on some of the contracts and products. It has been stated in more detail in our paper that we have submitted to IIFM, the draft paper that we have submitted. So for example, as we all know that a Murabaha arrangement entails a master Murabaha agreement. It could take the form of a corporate finance deal with periodical drawdowns, or it could be in the form of, for example, a revolving Murabaha. So therefore, the treatment under IFRS and under AOFI could vary. Under IFRS, it would be treated as a simple, or it would be treated as a loan arrangement. The change in the discount rate because of the change of the reference mechanism could entail basically reassessment of the SPPI test also. But because Master Murabaha is in the nature of an executory contract, it is not yet executed. Therefore, under IFRS, there will be an unlikely impact. Under AOFI, again, the impact is unlikely because the deal ticket has not been generated. However, Sharia implications such as gharar, because of the backward-looking mechanism versus the forward-looking mechanism, determination of rate on the date of the transaction, transaction being in the nature of sale and purchase. Therefore, gharar is something that needs to be looked at from Sharia perspective. And also under IOF, also the impact is unlikely because the transaction has not been executed. However, once the deal ticket is generated on the transaction date, the determination of sale price needs to be carried out in the contract. Therefore, under IFRS, because of the way the IFRS is structured, the cash flows, revised cash flows needs to be looked at. Economic equivalence concept needs to be again tested. Under IOF, again, it is debatable whether there would be impact or not, because on the date of the transaction, the selling price based on the rate of profit needs to be established. Once that is executed, there could not be change in the repayment schedules or in the profit and in the selling price. Therefore, it is debatable. It is dependent upon what the new mechanism would be. Therefore, it is not very clear at this moment what could the impact be. But under IFRS, definitely there will be an impact, and that impact would go into the P&L as a most likely as a charge. Similarly, under Ijara contract, once the rentals are fixed, the impact under AOF can be is not likely. However, for the future rentals under the master Ijara agreement, in the master Ijara agreement, again, it is an umbrella under which individual rentals for the future periods are determined. Therefore, the impact on the future rentals is likely under AOF, again, subject to the relevant accounting standard and the Sharia guidance. And under IFRS also, under IFRS for Ijara, we apply lease accounting standard IFRS 16, where on day one, the net investment in the lease and the determination whether it is an operating lease or finance lease, while under IOF, it is an operating lease for the lessor. So under IFRS, if the reference rate is being changed and the lease is for a very long period of time, there will be a change in the P&L. There will be an impact in the P&L because of the change in the way the net investment in lease and the future cash flows have been calculated. Therefore, there will be a likely impact under Ijara. Moving on to the next slide, please. For Mudarba Musharaka type contracts, again, there is a fundamental conceptual difference between the way IFRS would look at a Mudarba or a Musharaka contract from asset perspective, because it could be construed as a loan instrument with fixed or determinable rates. But under IOF, because these are more partnership type contracts, where the accrual of profit or is basically based on the declaration or on the announcement by the mudarib or the fund manager. Therefore, under IOF, the impact could be likely. However, underlying documentation, profit calculation methodology, the amortization schedules, all of that needs to be looked at to determine the exact impact. And also we need to refer to the relevant accounting standards for both Mudarba and Musharaka. And of course, the accrual of profit can be on a ad hoc basis during the life cycle of the deal. But upon the maturity of the Mudarba or Musharaka instrument, and I think we are going forward, AOF is going to make a change, and these will be termed as investments, Mudarba Musharaka investments, rather than Musharaka Mudarba financing, as the case was in the previous standards. At the time of closure of the deal, the real profit is established. Therefore, under AOF, it depends on how the contracts are structured. And whether it's a full AOF and applying entity, or it is an entity which is also following IFRS. But under IFRS, the impact will be likely because of the change in the reference rate and because of the way the discounting is applied under IFRS. I'll just skip the other item and I'll just quickly move to the last slide in the interest of the. So sorry, this was my last slide. I think all these items, these were just the highlights. We have noted down a detailed analysis in the paper that we have submitted. So if there are any questions, if there are any feedbacks, happy to take those either in this forum or as a follow-up discussion. Thank you.
Thank you very much, Muzammil. It was very helpful. And I think, again, I refer to the paper because some of the queries which are coming are basically we have covered in the paper. And most of the presentations are from what we have presented in the paper. So, and I'll strongly encourage to keep your questions in the chat box, please. So we will be really benefit from the next discussion and then in the world. So any other queries, any other understanding matters, like Muzammil have mentioned also, we will have to take it at a later stage. Otherwise, I think we will not be able to achieve the purpose. We just have to establish some roadmap, and then we will.
May I ask question? Not necessary to answer now, just to raise the question, the case. I mean,
if you send in the chat box, is better because that's where we will decide, inshallah, and that's the benefit for everybody. So I think that is what really needed. So I really appreciate that, for your understanding on that issue, because that the only way we can have a very good constructed meeting, inshallah. We have now good presentation on actually the issues and the solutions which are proposed. Against these are all proposed, so nothing is definite at the moment. So any questions that how it will work, what will happen, that we have to handle, accordingly. Also. We have to also be mindful, like, AOFE, if certain jurisdictions are mandatory, what will happen in the contract. So we use AOFE as a reference, and Fiqh Academy's, also, the fatwas in our work. And these are standard contracts which IIFM produce. So anything to do with as per IIFM mandate, naturally we have to, manage it, but we do coordinate. And sometimes, like I said, this could be a joint initiatives also, but the scope of the project is very big. So with that note, I would like to now move to, the next, which is the important part and the crust of this meeting, I would say, is yeah, but Sheikh, we have a presentation now on the solutions. So shall we? I think we have this one, and then we can have Mashayikh. So we'll try to finish this one first, because this is where the solutions are presented. We are reaching, Salah time in some places. So, Mashayikh may have to go, but I'll humbly request that we just do this last bit and then hear from the Mashayikh, and then, we can have some discussion, time allowing, inshallah. So very quickly, now we are not too behind. We are only 10 minutes, which is, I think, considering the scope, is quite, mashallah, we are progressing, alhamdulillah, in a manner. So now, this is the main sort of a topic which we wanted to see. Certain, alhamdulillah, suggestions and solutions are being, proposed here. These are just proposals. Later on, we have to do the actual work. So with that note, I will now request to basically for Mia Nazir to first please present, on his, views on the, Sharia solutions, and also the, the contractual aspects, So thank you for that.
Thank you, Ijlal Sahib. Assalamu alaikum, all participants. I'm mindful that respected Sheikh Nizam, Dr. Azlan, and Dr. Akram Laldeen are also on this call as well. So I'm not suggesting some solution and stuff like that. It's only a suggestion. So we still be, guided by, their wisdom and also their Sharia guidance in respect of each and every aspect that is, set out in my presentation. So the IBOR transition strategy for Islamic financial institution should be cognizant of the Sharia parameters pertaining to various Sharia nominated contracts. That's critical. This on page 2 of my presentation. And that is the foundation of all discussion. So Sharia requirement in relation to a benchmark or a profit rate or anything like that should be, there are certain Sharia requirements. One is that it should be neutral and should be capable of independently, verified. or verifiable, and should be, each and every component or element of formula or benchmark should be neutral and should not have any involvement from either of the parties, particularly in relation to a certain Sharia-nominated contract. The second aspect is when and how these rate and these benchmarks should be applied. So this is another Sharia limitation with respect to certain Sharia-nominated contract. The impact for Islamic financial institution is predominant for all floating rate financing and hedging transaction as well. So this is, on page 3. So we have identified what are the Sharia-nominated contract or a segment that would be, impacted. Ijal is page, 3. We need to move on to page 3 of my presentation. So there are 4 critical areas, which is a consumer and consumer wealth management product, SIPs, asset product are included, and personal finance and certain other products, they are basically fixed rates and they are not impacted. And corporate, almost every transaction is impacted, which are floating rate, and investment contract scoop and Islamic DCM, all form and all structures are impacted. And on the treasury side, we have asset liability product and hedging instruments. They are not affected. Can somebody change the slide, Jalal Bhai? Yeah. So now we know that following is the fallback supplement and protocol, we have some level of clarity on hedging instruments. So that is a very good thing that we can take it forward. We take it to Sharia scholar and see that what are their feedback and how to implement that as well. But guidance is clear, and we are happy and satisfied that that guidance is to a great extent aligned with the principle of Sharia. There are a few ifs and buts, so that can easily be resolved with the assistance of a Sharia scholar. So as highlighted by many participants, the impacted areas or accounting, IT, and also Sharia and legal, in respect of all new and legacy contract as well. So moving on to page 4 of my presentation. So understanding the exposure and risk, assessment has to be undertaken in relation to current exposure and risk associated with the IBOR transition, and consider risk mitigants and range of scenarios across the Sharia-nominated contract and transaction as well, and assess the customer impact and regulatory requirement as well. So critical aspect of this exercise is to formalize the fallback provisions, and for hedging purposes, we have now a clear ISDA fallback supplement and protocol. But as to other Sharia-nominated contract for a financing at treasury level and also at investment and corporate and consumer level, we do not have a clarity as to what would be the form and shape of these fallback provision as well, and how those will be applied. And then once we have an acceptable fallback provisions, we need to run it through the Sharia scholars and also the relevant regulators and also higher Sharia authorities, if any, in the relevant jurisdiction as well. And then move on to implementing their strategy as well. The critical aspect in this entire exercise is Ilarbai, can you change the just to next slide? Which is slide 4, which is this slide is very critical, because that is the foundation of all discussion in relation to the Sharia compliant requirement. So critical aspect is the replacement of IBOR, and that provides how the existing IBOR shall be replaced for predominantly all floating rate based financing. So transition from the existing arrangement to a new arrangement post December 2021, and that is a very critical aspect. Remember that we agree that there are certain Sharia sensitivities, Sharia requirement or limitation in relation to when one can change and when a contracting party or a two contracting party they can change the benchmark or the basis for calculation of a profit or any other income under Sharia nominated contract. So this is one aspect. And the second aspect is the definition of IBOR replacement event. That is also a very sensitive area from a Sharia compliance perspective as well. And then the definition of a relevant nominating body. We also discuss this aspect that from a Sharia point of view, benchmark has to be neutral and it should not be influenced by the contracting parties as well in a certain Sharia nominated contract. So this definition is also very critical. And now we know that on hedging side, we have clarity, but on financing side, there is still need to sort out this issue. Then the definition of the replacement benchmark reference bank, that in the event that anything happens similar to we have the existing market disruptions, so that also need to be taken into account. And the critical aspect of this entire exercise is adjustment margin. For ISDA, we have clarity, but for for other assets, for other financing transaction Sharia nominated contract which are on the bank facility side, we do not have this clarity. But one thing we are very clear that this cannot be uncertain, this cannot be fluid, it has to be certain. And we know that from IOP standards and other guidance from the Sharia board that there is a cap and floor requirement, in respect of these, adjusted margin. These cannot be kept fluid. And ISDA, there is a clarity on that, how that will be determined. That is clear, but in respect of the bank facilities and other Sharia nominated contract for other format of financing and asset product, this is a critical aspect that still need to be discussed and agreed among the scholars as well. And then what is the replacement benchmark? So language similar to something like a formally designated, nominated or recommended replacement for IBOR with adjustment for a variance of IBOR, a replacement benchmark, adjustment margin, and then if that doesn't exist, if A does not exist, length A does not exist, or then there is a reference bank concept that would apply, and that would not change because that is similar to the existing one. All we need to know that all we need to make sure that all these reference banks are pre-agreed, and there is no uncertainty as to when the party should have a recourse to them. So now on page 6, we have implementation of fallback provision under the documentation. So we know that there are two types of the contract, three types of contracts. A contract which they're already executed and they may run after December 2021. And these are the existing contracts. These are called a legacy contract. And these are the new contracts which the party may enter into from now onward and which may run after December 2021. And third set of the contract is the contract to be executed after December 2021. We do not have an issue with reference to the third category of the contract, but we do have an issue with reference to the contract which are a legacy contract, and as to the contract which are going to be executed now, there is a fallback arrangement as well, and the parties can easily work with their respective stakeholder in order to come up with a Sharia compliant or commercially viable legally enforceable arrangement as well. But as to existing contracts, there are certain sensitivities, and that would require an amendment approach. An amendment approach requires that the both parties they negotiate and come to an acceptable solution as well. This is something in relation to the approaches, which is one is commonly known as they commonly call it, and they describe it a hardwired approach and amendment approach as well. Now moving on to to adoption of the replacement benchmark, which is page 7. The arrangement is as follows that in relation to the fallback arrangement, to the extent that the forward-looking screen rate, which is basically a term-adjusted risk-free rate, is for the relevant period is available, then such a screen rate shall apply as an industry practice in all transactions that involves floating rate financing. But to the extent that forward-looking screen rate which is term adjusted risk-free rate, is not available for this for that period, then the screen rate shall be determined on a backward looking, setting an area on compounding basis will be used with the adjustment mechanism. And how that adjustment mechanism is described, that is, you will have a 3 limb and and your determination. Limb 1 is the applicable screen rate for the applicable previous period. Limb 2 is the difference between the screen rate that was applied with respect to the previous period and the actual screen rate that prevailed for such a previous period. And the third is the replacement benchmark adjustment margin. So with reference to the two, in any profit period, with in respect of any transaction, that can be recovered on the profit payment date or deferred payment date of a current period as well. So that is basically the easiest and the most convenient way of arranging a transition from a current to a new new rate, and while ensuring that there is no financial loss to the respective parties, and also the arrangement is certain and clear from a Sharia point of view, and it does not involve any ambiguity, any uncertainty, or any potential for dispute. So that's how we envisage. Now on page 8, there is an assessment of is there any challenge or are there any difficulties, and to what extent Sharia the very Sharia nominate contract are capable of accommodating or reflecting the new arrangement. And we know that new arrangement is based on backward looking compounding basis and setting in arrears. To what extent the existing Sharia nominate contract are capable of accommodating this concept. I don't want to go into permissibility aspect and non-permissibility aspect, but I would like to highlight one thing, that if we have if we categorize and classify Sharia nominate contract into 4, so then you have an ijara, and then you have a service agency, asset-based transactions, then have your muraba, and then you have musharaka, mudarba, investment wakala, or the combination of various. So in terms of ijara, be it finance lease or operating lease, we do not see any challenge, although rate is set in advance. But in all cases, in ijara, and particularly in finance lease, you have an adjustment mechanism, because rate is is determined on each rental notice date, and you can have an adjustment mechanism same as I described earlier. And if towards the end of the lease period, you can have either sale and taking or purchase and taking, and in the excise price you can reflect any amount that you can calculate. So we do not see any structural change in or any structural challenge in ijara transactions, because the existing structure is capable of accommodating any new any new arrangement. And we know that what that arrangement is, and that is ijara transactions are fully capable of accommodating that requirement. But all we need to do is we need to tweak the definition of the excise price or the rental for the subsequent lease period. So that's very simple and straightforward, if I am not oversimplifying stuff, but it looks very simple. It is simple. And now the second category is the service agency contract, which technically this is income based transactions. So here profit, income, whatever the case may be, is determined towards the end of the profit period. So technically, the new arrangement, which is backward looking, compounding and setting an arrear, that can also be applied, because there is a complex mechanism of determining that amount. So basically, in all cases, indirectly we call it incentive threshold, and how much amount is required to be paid to the fund provider, and how much amount is required to be retained by the service agent. That can easily be adjusted, and there is a mechanism in all cases we do not see any challenge in sufficiency because they are income based, and income is usually determined towards the end of the income period as well, and we don't have an issue. Now coming to the sale-based transaction, which is murabas or another a few categories of a sale transactions. Here there is a challenge because rate has to be agreed in advance in a figure that has to be determined in advance. So here there is a real challenge, and here the challenge is with respect to all form, be it a funding, be it including a muraba in capital market or DCM transaction or hedging and everything. Here it is a problem. In hedging, which is swaps and derivatives, we have clarity on that as well, and also there is a spot muraba concept and swaps. So technically, the party can negotiate and agree on a rate, and that can easily accommodate the new mechanism and a new approach, a new regime as well. So there is no issue with respect to the swaps and and particularly now in respect of with respect to the legacy contract, there is a legacy arrangement. There is a clear guideline from ISTA, and that can also apply. And there is no uncertainty as to both term adjusted rate and also term adjusted risk-free rate and also the adjustment margin. Both definitions are very clear, and also the body that is going to have role in that is also a third party. So, and also very clear as well. So we don't have any challenge difficulty as well. And particularly when there is a spot rate muraba concept, so there is no issue. With respect to the banking and finance facilities, yes, there is a challenge. And that challenge can easily be overcome by choosing various structure, and one of these structures is set out on page 9. So on page 9, I'll come to that after my observation on Musharaka, Mudarba, and investment Fakala. So I'll pause it for a while and just move on to Musharaka, Mudarba, and investment Fakala. This type of the contracts or these Sharia nominated contracts are similar to service agencies and ijara. So that there is no issue. All we need to do, we need to tweak the definition of incentives and income, income and profit or expected profit, and also the timing. And if there is a purchase and taking or sale taking to the extent applicable from a Sharia point of view, and in certain extreme circumstances, there you can add that and excise price these elements as well if you cannot include it in the liquidation proceeds. So we do not have any challenge. And with respect to the muraba, what we did is we use a similar approach as we did for ijara. So all we need to do is we will begin a contract with the previous rate, and then before the next muraba date, which is usually happening either the same day or 2 business days using the backward shift mechanism. You determine the amount, and you can have a 3 second element included, as we discussed on page 7 of our presentation, which is LEM 1, LEM 2, and LEM 3. So this LEM 2 is basically the difference between the screen rate that was applied with respect to the previous period and the actual screen rate that prevailed for such a previous period. So if you look at page 9, so that illustration will give you a fair idea about how the muraba contract can be a floating rate muraba contract with multiple subsequent muraba can be achieved. All we need to do is there is a one small issue, which is final profit period. And a final profit period, what you do is you need to divide the profit period into 2. A longer period, for example, if it is for 90 days, so one muraba will be for 3 days, another muraba will be for 7 days. So technically, without compromising on the commercial realities, this can also be achieved. So for example, profit for the first period would be L1 and LEM 1, which is say suppose 1.6%, and LEM 2, which is a 0, and LEM 3 is a difference, which is 0.10, and then the total profit is L1 plus L2 plus L3, and then the same mechanism. If you look at for a more clarity, if you look at last two formulas provided in respect of profit period for 83 days, and also profit period for for 7 days as well. So this is a very acceptable arrangement, and that's how we can ensure that all Murabba contract are capable of accommodating the new requirement, which is backward looking, setting an area and a compounding basis as well. So that is something that can be applied in respect of all sale-based contract. But as to hedging contracts, this mechanism will not apply, because hedgings are all spot contract. And a spot contract, if the formula is clear on day one, you can do a spot transaction. So we don't see any challenge, any difficulties there as well, unless we have unless there is another unique requirement. However, as to calculation of the index amount or a termination amount, that area is still a gray area from a Sharia point of view, because that involves certain uncertainties, but that is not subject matter of discussion at this point as well. We'll continue to discuss with scholars and come up with something that is more Sharia compliant. So this,
mashallah, it's sorry to interrupt. It's such a lovely presentation, and we are learning a lot. But if I see the time,
just give me 1 second.
Yeah, so I know others will not like it. Also, I don't also like to interrupt. But inshallah, we will also include in the paper a certain aspect. But it's wonderful if you can finish in 5 minutes. That will be good, inshallah.
So yes. To preempt that, any challenge. So what we did is, we provided a suggested language for facility offer letter, in order to allow IBOR transition. So that is on page 12 of my presentation. So that's how this fallback language that will go into facility offer letter for bank facilities. And then on page 13 to 15, we have a two suggested language for bank facilities, which is for IBOR based, and there are 3 paragraphs very critically: replacement of the screen rate, and then there are definitions and when to apply. And also here there is a small issue. It was prior to that, because the replacement benchmark is still on the old, and the Sharia sensitivity as to certainty is still missing, but that can easily be discussed if it is going to be determined by third party, or with reference to the mechanism as set out and is the supplement and protocol. So these are basically provisions, more or less we have taken them from ICE benchmark administration limited standard language. We tweak them to make them compliant and allow institutions to use them in their legacy for amending the legacy contract, and also for a new contract that would run after December 2021. So I do agree with most of the participants that this task is going to be going to entail a few other stakeholders involvement, particularly IT and also accounting and legal and Sharia as well. So that's all from my side, and thank you all for having me on this panel, and also for your patience as well. Thank you.
It was a really wonderful, mashallah, what you presented, and I wish we could, had in person, so we could have really gone more into details. So there's a lot of work has already been done, an assessment, and clearly we can see, and we've been part of working group with, so core working group, which we can expand now, but that will really certainly help us. Without delay, we go to now Usama Umar of Standard Chartered, Sadiq, to also talk about the solutions. And this is, mashallah, is a good, these institutions, particularly Darul Sharia, Dubai Islamic, and Chartered Bank, that they are sharing this, with us, and then to develop the paper. So certain queries and all we will cover in the paper. So if certain presentation and all, it's basically is for this forum maybe. But the paper what we have circulated is a draft form, as you see. and we will be making it, inshallah, with your input and what we are discussing in a final form, which can be used by the industry generally for information purposes. It's not really there. One can, come out with the solutions and everything. They're a huge task, as one can see, and particularly each standard setting organization, at least three of us, IFM, IOFI, and IFSB, we have to do our related work, either our own or jointly, inshallah. So, Osama, please, to you, and then inshallah we will move to the Mashayikh, and then we can have some discussion. Generally, again, please put your questions in the chat, and we'll try our best to, inshallah, address. But this topic, I will also say, I saw one or two other chats, is not really covering, the Islamic rate and some other issues and all. This one is focusing as a real problem we have. So certain transaction will continue, using, the global benchmarks. So it's not that we can just move, to something new, which inshallah that we are also very supportive that we develop, as we go along Islamic rate and, those things. But that is another topic I said, and that could be inshallah, address also, Bahrain Waqf Fund has done a roundtable, and maybe some other additional work will be done. Where all standard setting bodies and stakeholders are part of that exercise, inshallah. So, Omar, over to you.
Thank you, Brother Ijlal. Thank you so much. So my presentation will be focused on proposing the solutions for two most commonly used structure. First is the commodity muraba, where we are proposing two solutions. And secondly, the ijara and demolition musharaka. So in the commodity muraba, the first variant that we are proposing is the dual tranche structure. So as pointed out by Mia Saab in this presentation, that the challenge is not so much on the hedging product, because we are using the spot muraba mechanism. The challenge is mostly towards the lending products or deferred payment structures, where the payment is due at a deferred time. And hence we are facing this issue with risk-free rate, which are backward looking, and the challenges there to be addressed. So what we're proposing here is a two tranche structure, which is the variant one, the dual tranche structure, whereby the first muraba, if you could move to the next slide, whereas the first muraba would take place at the beginning of the transaction. It would be a long-dated murabaha, which essentially ensures the repayment of the principal amount. And then there would be a second tranche, which we are naming as tranche 2 for Muraba Bs, which is a series of a spot Muraba transaction. And what's going to happen is that in that transaction, if you move to the next slide, yeah, the tranche 2. Yeah. So what would happen in this case is that before the settlement date of the transaction, which is typically 2 days before the settlement of the transaction, we would know what is the profit accrued based on the risk-free rate. So we know and accordingly execute the spot muraba transaction. The way it would work is that the principal amount will settle itself, the cost price, whereas the net outflow in this leg would only be the variable profit, which is essentially calculated at risk-free rate, which is SONIA or SOFR, depending on the benchmark. And the only cash flow is the payment of variable profit from client to the bank. And this is repeated at each settlement time. So in the interim, whenever you are making interim settlements, you'll do the spot muraba using this mechanism. Next slide, please. Yeah, so there are certain considerations that we need to be mindful of, because when you're doing a long-dated muraba, we are picking up the cushion, but it is quite likely that RFRs during the tenor of the transitions increase, and we might need to enter into additional murabahas during the tenor of the trade, so that the buffer keeps on increasing, and if the client defaults, so we have cushion available in the additional murabahas. Another consideration is that if the client is refusing to enter into a spot muraba transaction, we'll consider it as event of default, and we'll try to accelerate the transaction. Now, despite all these risk mitigant, we have a residual risk that, if the risk-free rates increase substantially and the cushion is not sufficient enough that we have in place in terms of additional murabaha or the beginning the initial Muraba, transfer Muraba, then we might explore a concept of Musawa undertaking, which is used commonly in the hedging concept to put a claim on the customer for the to capture the risk of losing on the profit if the rates are substantially high. Another point, and somebody raised this during the chat also, that we need to be considering the IOP implementation. So this structure we can use in the UAE as well for addressing the implementation.
आप कॉल पे हैं?
Yeah, so this structure we can use for the implementation of the IOP Sharia Standard 59. So that is our first proposal. If we could move to the next slide. Yeah, so we are proposing another structure which we are calling a ceiling rate structure. The way it would work is that bank and the customer would enter into a single murabaha based on the ceiling rate, which have a substantial buffer compared to looking back rate on the risk-free rate. So let's say if the risk-free rate on average looking back is 5%, hypothetically speaking, we'll do a ceiling rate muraba at 10%. However, what would we agree with the customer that there would be a commercial pricing also, and based on that we'll make the interim payments from the customer. So actually the customer would only be making payments, periodic payments based on the commercial rate. It's just the question that we are building up at the beginning of the contract, so that if the rate we have sufficient cover available in terms of obligation from the client. Another mechanism that I'd like to build up in this structure is that there would be a concept of rebate, discretionary rebate, and for that we'll issue an undertakings to the customer. Bank will issue an undertaking that will enter a spot muraba to pass on the rebate if at the maturity of the transaction we identify that there is a benefit that needs to be passed on, and the differential between the ceiling rate and the commercial rate. Moving on to the next slide, please. The next slide, please. Yeah. So again, there are a few considerations here that there are two undertakings under this structure, one from the customer and one from the bank, to settle the differential between the ceiling rate and the commercial rate, which is the actual rate payable by the customer. And this will be done through the spot murabaha mechanism. Again, as I identified in the previous structure, there is a sort of a residual risk that the rates during the trade go so high that we can't cover it from the cushions that we have built up through ceiling rates. Then in that case, again, we may explore with the approval of Sharia scholars, of course, a concept of Musawam undertaking to make good for the loss that we might incur in this structure. And the last point on this is that we, like the previous structure, we can use this structure for addressing the issues that we are facing for IOP Sharia Standard 59 implementation in the UAE specifically, and this structure may be helpful there as well. So this is for the commodity muraba. Now we move on to the next slide. Again, the next slide, please. Yeah. So generally the way Jara's transactions or diminishing Musharaka transactions are being done is that you agree the profit benchmark at the beginning, and they're at the beginning of the period. So in our opinion, although Mia Sahab has pointed out that there is no challenge in Ijara, but in our opinion, there is a challenge exists. So what we are suggesting here is that there are two structures. One we are calling a daily rental structure, and the other one is the breaking the calculation period into two sub-rental periods. So I'll cover the daily rental structure first. So the way it would work is that you would have a typical Ijara agreement and purchase undertaking entered with the customer at the beginning of the transaction. You'll redefine the rental period into a daily daily basis, which generally is a quarterly, depending on the underlying contract, but it's generally a longer period. But because of the issue with risk-free rates, you don't know what would be the rate at the because the rates are daily changing. So what we are proposing here is that each day would be a rental period over the period of the whatever is the calculation period over the period of the transaction. Now the challenge is how do we enforce ijab of qabul, which is an offer and acceptance, which is the requirement under the ijara contract. Here we are proposing that it will work on the team acceptance basis. The client will have the access to the rates through a website, and it would be referred in the contract. And if the client doesn't like the rate, or if wants to discontinue the transaction, if he disagrees on the rate, we'll kick in the undertaking the purchase mechanism to early terminate the transaction. Another point to note in this structure is that the payment will not happen during the calculation period. So within our risk-free rates also, the payment mechanism is such is that it is happening at the set frequency. So while we are accruing or calculating the daily rental, the payment is at the end of the calculation period. It should be typically 3 months or 6 months or a year, depending upon the arrangement. We may move to the next structure. So this is the other structure that we are proposing here. It's essentially splitting the calculation period into 2 sub-rental periods, and it got somewhat similar to what Miyasa proposed in his Murabba structure in the last leg, where you split the calculation period into 2 sub-rental periods. So typically, what would happen is that after execution of documents, you will fix a rental for the period looking back at certain risk-free rates, and you will assume an X rate, and you book the transaction. And the transaction would and the rental period would end when you have the certainty on the risk-free rate, so which is typically 2 to 5 days before the payment. As you know, there is a freeze period in the hands in the calculation of risk-free rates. And what would happen that you would have another sub-rental period, which we are calling a second sub-rental period. And in this period, you will check the profit differential. So you'll see that at what rate you have booked the transaction, and you see what have been the actual calculation by looking back and comparing the calculation. And accordingly, you will build up that profit differential, either it's a positive number or negative number, in the second sub-rental period, and accordingly conclude the transaction. So that is the proposals from our end. Over to you.
So, Soma, thank you so much. I think these are what you presented. Again, I may have to repeat, these are suggestions. So I can see, certain questions which are being raised, what will happen, what is the Sharia, the AOFI. You can clearly see, mashallah, from this presentation that naturally we are not going to, AOFI standard recommending any change in that, but we are basically looking at it, in terms of how, practically things can be applied and the standard can be used. And like I said, the contract work, documentation standardization is something which IIFM has been doing. And I'm, all of you are, alhamdulillah, aware of that, what we do as IIFM, and then IFSB and AOFI in particular. And that's how we'll do. And also we will also look into, how certain things can be done jointly. I can see some more questions, but I think at the first stage, and these questions are mashallah helpful, so some of them can be incorporated in the paper, how we are going to do it, and then find one solution. Like I can see comment that will be very difficult, but we have to find a most workable from standard setting body point of view. We have to find 1 or 2 which are widely acceptable, both from the legal aspect. Sharia, of course, is the paramount, and also operationally as well. So these are all things we have to incorporate, and alhamdulillah, we have been able to find workable, widely acceptable solutions in standards form, and there is no reason why we could not find. Of course, we have to work with institutions like we alhamdulillah today are sharing their internal work, what they have been doing, and to take it forward, what is need to be done by particularly the standard setting organizations for the wider benefit of the industry. May I, although Mashayikh, mashallah, have been waiting for a long time, and I hope what been presented was useful, and in terms of knowing the subject, which was some of the things were known previously, but some of the things, mashallah, being highlighted today are, I'm sure, very helpful, as you may have noted. So can we, I may request Sheikh Dr. Nizam Yaqubi, if you just like to just provide his comments at the moment. We are not really asking for any guidance or any solution to agree or disagree. That's not what we are going to do, inshallah. That will be the next phase, which Sheikh is also very aware, alhamdulillah, and Mashayikh, that's something we do it, when we do our actual work. And this exercise is leading us, inshallah, towards the actual work, and inshallah, the objective which I mentioned, that was the meeting objective, which I can see, we are, alhamdulillah, proceeding in a clear manner. So Sheikh, if you like to comment, what we discussed and presented from, your general point of view.
بسم الله الرحمن الرحيم الحمد لله والصلاة والسلام على سيدنا رسول الله وعلى آله وصحبه ومن والاه. Assalamu alaikum wa rahmatullahi wa barakatuh. Dear stars and all who are joining us, may Allah subhanahu wa ta'ala bless them all. And نسأل الله تعالى أن يكشف الغمة عن الأمة وأن يرفع البلاء والوباء عن بلادنا وبلاد المسلمين وجميع بلاد العالمين. We thank IIFM and Brother Ijlal and his team, Dr. Rifai, and all the supporting team for arranging this very important gathering and this electronic meeting. And inshallah, we will meet soon face to face after this pandemic is gone, inshallah ta'ala. What I want to say that all the solutions and suggestions that have been suggested by whether by the brothers from Standard Chartered or Sheikh Dr. Mian from Dar al-Sharia, and or before that it was presented in one of the AWOFI conferences, what the brothers in Irti, Dr. Sami Swalim, have suggested the use of the Taylor formula. Yani, all of it can be implemented in one way or another with one adjustment or addition here or there. I think the important thing is that we as an industry, all of us, we should unanimously recommend one particular suggestion. And if we do that, then it will gain and it will have momentum. So if AWOFI, IIFM, IFSB, central banks, and also the participating banks and solutions, all of them agree on one particular solution as the recommendation, which should be practical and universally applicable, and at the same time represents at least, if not all of our theoretical background, some part of our theoretical and fundamental maqasid, that we don't want it to be based on the interest part of the element, but to represent either the market or to represent, for example, the real costs and etc. So from my point of view, we should all agree on something and then present it to the world. But if we go disunited, if we go separated, everyone is suggesting this or that, we will have no value in the market. This is our chance now, the chance which we were waiting for it for a long time, because nobody liked LIBOR. يعني she was like an old and ugly and bad and mean wife or companion or partner or whatever you want to say, but you had to live with it. So I think that يعني now it is the time, because she died or she's going to die. يعني. So it is now our chance to يعني find a suitable recommendation. That is my 10 cents, as they say. I have nothing else to add to what have been sent by the learned brother from this matter. Shukran.
Shukran, Sheikh. Jazakallah khair. Mashallah, what you mentioned, is something we look forward. And like I said, we really, when I joined the industry, now alhamdulillah, it's been many years, the Islamic rate, and I think that's something we have to work. But like, mashallah, you also mentioned that we have to work, together in terms of, both things handled together. In a separate way, forum, the Islamic rate, which we need to develop. As we know, there are challenges, and that's something we need to work. And what was presented in AOFI, we assess that, and there will be certainly something being organized, which IIFM was also, our chairman also mentioned to us, what sort of we can do. And then actually the other thing is this practical aspect, which is now the real thing, that moving from the LIBOR, which is finishing because of its, whatever we mentioned, the issues it had, to really risk-free rates. So this is, the industry has to carry on. Certain transactions which are existing has to be, contract has to be adjusted for that, or, solutions to be found for the new transactions. So all that, mashallah, and then IT issues being raised also, which need to be done. So this is, I think, our focus at the moment, is in both aspects, but I think this is also critical for the industry to continue and, in a clear manner. And like, mashallah, you mentioned, the unified, approach, which we can take one or two solutions, which we always do, which can, inshallah, work, for the industry. And we sort of, if needs to be, linked to the global rate for dollar and anything, we can, these currencies which I mentioned, we can certainly, sort of have to find that solution which will help the industry, inshallah. And then, Sheikh, inshallah, we will be, with your guidance also, we'll be working on that, and other mashayikh, inshallah. May I now request Sheikh Akram to please provide his views, his comments on this.
أعوذ بالله السميع العليم من الشيطان الرجيم بسم الله الرحمن الرحيم الصلاة والسلام على رسول الله وعلى آله وصحبه أجمعين. Thank you very much, Brother Ijral, respected Sheikh Nizam Yaqubi, Dr. Aznan Hassan, Brother Mian, and other brothers and sisters who joined this forum. And I would like to take this opportunity first to thank and to congratulate IIFM for this, I think, very useful and also very insightful thinking about how we are going to move forward when it comes to the benchmark. And I think, as pointed out by Sheikh Nizam, I fully agree with Sheikh Nizam that we need to come up with a unified voice, because I think all this while we have been talking about coming up with an alternative Islamic benchmark. And this is an opportunity for us to move forward and to come up with an alternative benchmark. Now, just maybe a few points that I would like to point out, perhaps, I mean, can be considered to be discussed as well. One is that, as all of us know, that you see in the different contracts that we use in Islamic finance, I mean, there are different purposes. You see, you have trading contract, let's say Murabaha, it is a sale contract. You have Ijara, for example, it is a lease contract. You have Musharakah, Mudaraba, you have Wakala. And I mean, all these different contracts have different purposes and different underlying objective of this contract. And I believe that it is timely for us also to look into the possibility, you see, at least at the retail level, is it possible, for example, for Murabaha, we use certain benchmark that reflect the true trading exercise that is in the market, that is prevailing in the market, for example. And I think nowadays data, I mean, you can get data. For Ijara, for example, look at the rental index, the prevailing rental index. I mean, it might be tedious exercise, but if we are able to do this, at least we can, you see, fall back whatever benchmark that we are doing to the very purpose of the different contract that we have in the market. So I think that is one of the suggestion that perhaps it might be worth for us to look into it. And I understand that, you know, it will be very difficult in a single market to have a different benchmark. I can understand that. But if we can do that, you see, and prove that, okay, when we are talking about Islamic finance, you see, we always focus on the underlying contract. Perhaps it might be something which is worth to think about it. Perhaps it might entail the changing its monetary system or what, you see. So I think at least we can start somewhere and we can progress further. And the existing benchmark, like what we discussed on the RFR and whatnot, we can use it for specific kind of transactions, and we might have, I mean, different kind of benchmark if that is possible. Again, I think as pointed out by the Ijlal, I mean, this is a preliminary exercise. We still need a lot of engagement. We still need a lot of discussion among the scholars, among the practitioners for us to move forward. So I would like again to thank IIFM, and I think all the brothers that have provided a very insightful, even though sometimes there are certain technicalities that I struggle to understand it, but I think, I mean, it is a good sharing that we can further enhance it in our discussion in the future, inshallah. Thank you very much. Jazakumullah khairan. Assalamu alaikum wa rahmatullahi wa barakatuh.
Shukran, Sheikh Akram. Jazakallah khair. It was very helpful. And inshallah, I think another thing which we will do is this paper, which will be help of all the participants. And I can see, mashallah, all of, you know, participants, institutions, they are there. So we continue to have a, you know, level of, you know, participation, although the time we have extended. And you also rightly mentioned this issue is huge. And there are two aspects which I clearly mentioned in the beginning. And mashallah, you also highlighted both issues to be tackled. So inshallah, you know, we can now, you know, at least plan it out and in our next phase, what we can do, what is the priority, you know, what we established now today, and looking at, you know, the fallback like that, contractual issues, Sharia solution, which, you know, also need to be done. So, and that is the objective of the meeting, which, you know, I had highlighted. So Jazakallah khair, inshallah, we'll be, you know, taking this further. May I now request Sheikh Adnan to provide his comments, please. Is he there or?
Assalamu alaikum wa rahmatullahi wa barakatuh. Alhamdulillah, salatu wa salam ala rasulillah.
Sheikh, very good background.
Sheikh Hassan, are you in Labuan or what?
Try to imagine in the beach now, at the beach now.
You're tempting us, Allah. You're tempting us to, you know, what are we doing here?
Thank you very much, Ijlal, IIFM, all the shuyukh, and also all the presenters and the participants. Very good presentation, very good and useful discussion. I think, first of all, I would like to first say that this is my personal opinion. I've seen and commented on this matter in several other forums, in central banks, in some other forum. So, but this one is, I think, is my personal opinion, nothing to do with the banks that I advise or any central banks that we also advise on that matter. Okay, first of all, I think we need to look at it from two angles. The first one is that even though I know that it's very constrained for us to look into the alternative Islamic rates, I believe we should not limit ourselves to only use RFR, risk-free rate, and also how for us to accommodate that from Islamic point of view. We should continue looking into the alternative, which is more compliance to the Islamic rates for that matter. That's the first one, I think. So we shouldn't forget about that. While we are facing this in a very tight time, we have no way to move in particular time, but we should not forget our main purpose of having our own rate that can serve Islamic finance better. That's the first one. Second one, talking from FRR, risk-free rate that we have now, main challenge that we have is that how for us to move from LIBOR, which is forward-looking, into this risk-free rate, which is actually look-back basis. So this is shift from the Sharia way on how we do the contract and so forth. And that will affect murabaha, that will affect ijara, that will have musyarakah. In fact, musyarakah also different when you talk about musyarakah mutanaqisah, which is syarikatul milk basis, from normal other syarikatul aqad with investment-based basis. So a lot of things need to be looked into that manner. I prepare a lot, I mean, quite lengthy. I'm going to make it simple, I mean, for this discussion. I don't think we want to go to detail and the technical part of it. But put in this manner, when we talk about implementing RFR rate for that matter, risk-free rate for that matter, we have two situations. We are facing, the first one is that contract to come after the demise of LIBOR, and contract that has been in existence that we have now and going to continue even with the coming of LIBOR. There are two things there. Let me go for the second one first, is that the contract that we have now, for example, we have revolving murabaha on semi-annual basis or every quarter basis that will encroach into LIBOR after the, that will encroach into the demise of LIBOR. How for us to deal with that? We have two situations. The first one is that when we deal with the customer agree to it. That one situation. Then we have to understand what is the fallback language. That's the word that we have to use. What is the fallback language for that? That is the first one. Second one, what happens if the client and us refuse or fail to agree on a particular new mechanism of price determination? In some of the contract that we have gone through, they said that the revision of rate shall be done on mutual consent basis. So what will happen is in situation in which we fail to arrive at certain particular price mechanism to be agreed after the demise of LIBOR. That's the first one. When we come to the second one, where we agree, or the new transaction that come after that, so we have to look into the contract that we have. Mr. Mian Nazir and also our friends from Usama from Standard Chartered has put 2-3 structures that to me we can try to explore on that matter. Especially when it comes to revolving murabaha. Even the contract that we have now, if it is a fixed rate contract, it's still been an issue because it's going to continue forever. But the problem is a floating rate and a revolving in nature, what we call the muraha ad-dawara, the revolving murabaha. That where we have to look into what are the mechanism and how for us to translate the looking forward basis that we have into a look back basis that is going to come after the after the demise of LIBOR. I believe the structure put by our brother Mian and also our brother from Standard Chartered Usama, I think this structure can be explored further. We have to look from the IOF point of view, and also don't forget about standard 59 of the IOF. This is very important to ensure that we don't have the revolving which does not fulfill the Sharia requirement. My comment on that, I think I stop there. Otherwise, we have to go each and every contract, murabaha, ijara, wakalah-based, service-based contract. Musyarakah, we have to divide into two, the musyarakah mutanaqisah, which is syarikatul milk basis, and also musyarakah, which is syarikatul aqad basis. So it's going to be a long discussion, but I believe we should look into how for us to be able to accommodate Islamic banks all over the world when it comes to the risk-free rate coming the demise of LIBOR next year. Thank you very much.
Jazakallah khair, Dr. Azlan Sheikh. MashaAllah, the background is real, I hope, because these days, something, but it's really making us, it's so nice and I think refreshing. And although I can see the people are already, all of them are there here at the moment, most of them, so nobody left. So Alhamdulillah, we are having a good discussion and rightly mentioned, the Islamic rate, which we all inshallah hope for. But at the moment, unfortunately, this focus is on our, what objective I initially presented. And I think what you, mashallah, mentioned, that the solutions which are suggested by the two, Darul Sharia, Dubai Islamic and Chartered Bank is something we can look. But having said that, I also received from some institutions that they will be sharing their suggestion if we missed something, or maybe I think these are the ones generally banks are looking for. But we definitely like to have, if we have institution even from Malaysia, if there is some other solution, we will be definitely like, and perhaps if be included in our paper to finalize that. And these are all sort of suggestions. So there further Sharia guidance on how AOF 59, although it mentioned that how can be implemented. That was mentioned already, and we are mindful that these standards are there, and we just have to find solution. We are not really debating any standard, and especially official Sharia standards on that. We use that as a reference of academies. So Jazakallah, for your, and we look forward to, inshallah, when we do the actual work, your guidance, inshallah, and other mashayikh also. We just had few, we thought maybe in this meeting, we could just have few, and alhamdulillah, I think we discussion has proceeded as I was expecting, going towards 3 hours, but I think we are having, mashallah, a good, and focused discussion, which is, I think, was the purpose. So may I now start the, the open discussion, which again, I will be little, if you don't mind, we like to focus on the objective, which I mentioned. So if you place the objective again, and then, we sort of can take few sort of, not, I don't think so, we can take all of it. Some, mashallah, brothers are asking questions and already been replied. In some cases, I can see most of the queries in the chat box. And if certain queries are still, pending after this meeting also, we can, inshallah, look into it, and we'll try to incorporate those in the paper, or maybe highlight the issue in the paper that this is further work to be done. But like, alhamdulillah, we are able to now organize this meeting, which in particular, I've been, trying to organize and also discussing with our, board and our member banks, including IDB, in particular, also Brother Khurram, and and others. Yeah. So if I start, first, if you allow me to just, if Brother Khurram can, give some comments, and on this, and then others, if we can take, just to be focused. If you put the, the objective, keeping the objective in mind. So I'll be really, very grateful for that. And also, looking at, from central banks, I think also if there are comments, so we can take from the central banks. We have a number of central banks. If they have comments, we would like to, UAE, I have seen central bank that was more on the AOF implementation, and that we clearly mentioned. And so, Brother Khurram, if you like to start, and then we sort of, inshallah, and others can have. And,
Jazakallah khair, Brother Ijlal. Thank you very much for organizing. I think it's a very, very useful event. A lot of perspective have come forward. And I think one of the fundamental objective of organizing this event was, one, to create awareness in the larger Islamic industry for banks to realize that this important incident is happening, because often we find that banks who are more focused in the local market tend to ignore the developments in the international markets, but eventually they do come and impact us. Like, for example, as we saw in the case of the margin reforms project that we did through IIFM. So I'm really grateful for IIFM for organizing this. A lot of thought-provoking discussions have happened, especially in the chat box. Also, people have freely expressed their views and also raised questions. But I think this is just, as you said, a stepping stone for a conversation that, inshallah, IFM will play a leading role to bring the industry together, and hopefully, inshallah, in time, we should be able to find solution, because as was highlighted by some of the presenters, timing is really critical here. We have a very short timeline in front of us, where we need to put this together. And the challenge that we're facing is that, God forbid, if you're not able to find alternative solutions, you may find Islamic banks being left out in the international market, especially in the syndications market. So again, thank you very much for organizing the session. Looking forward to the work that we will be doing this going forward. Thank you very much.
Walaikum salam. Thank you so much. And again, I would like to stress that, that we sort of, from IFM, among the discussion I can share, with this forum, that we did discuss with AOFI from the beginning and IFSB in particular to basically, work together in certain areas, and at least, and we are grateful they also joined this consultation to start the process. And we, from IFM, driven, more on the, in keeping IFM in the cross-border international market and in issues. So we, as a, in principle, decided, and and discussion with AOFI and AFSB in particular, that we will basically focus on the implementation of global benchmark rates. That's something which we don't want to basically, international markets like syndication market, even hedging, we have our standards are very widely used, alhamdulillah. Now we have some things in the execution level which need to be done, which ISDA has done. Naturally, they have done for conventional, and as the case, IFM always we lead for the Islamic. So their role in the Islamic is not really to work with us on the structuring, that we lead that in their respects, and what amendment or document drafting to be taken, as most of you are aware of that. ISDA, of course, if there is a hedging, we will jointly work, but it's driven by IFM. Their role, in some cases we have, on the legal opinions, when we have recently, we issued a UE legal opinion for Tahawud, and we do jointly for benefit of Islamic industry and our members in particular, and ISDA naturally do it for but their focus is always, conventional, and we basically lead in terms of doing for the Islamics in our mandate. And alhamdulillah, everybody is clear about the mandate of IFM and AOFI and IFSB. And when I joined many years ago, alhamdulillah, with the grace of Allah, we have really able to establish, and do certain things, and with the, support and help, we will further progress. So now, I mean, without further lecture, I don't want to give too much. I would like to see if any regulator has any point to say, keeping in mind this objective which we are displaying our institution. So if we can take as much time, but looking at the scenery, what Dr. Aznan presented, also and I was getting late in Malaysia and someplace, we probably, if we want to keep a discussion, let's keep it for 15 minutes or so. So if I just, and we just, again, we'll keep it focused, inshallah, keeping in mind, objective, what we want to do, and, to have a roadmap, really. I can see with the presentation and discussion that there is some roadmap is already, for us to look at. But then again, your, input now would be really helpful. And I wished we had more hours for that. But, again, if somebody wants to really, comment, please go ahead, starting from regulators or IFM board members and others, of course, members and participants.
Brother Ijlal, can I start?
Sure, Brother Yasini. And I know you are the one who mentioned something which will be working with us, inshallah. So please go ahead.
Jazakallah khair, yeah. Thank you so much. It was very useful, and it was great to see so many friends and colleagues, ex-colleagues on this call, and friends from the industry. I wanted to share the Bank of MUFG Bank experience in this, because we are working on alternatives as well internally to meet the deadlines for RFRs. We have discussed with our Sharia board as well. Sheikh Nizam was on this discussion today. He also has approved 2 structures for Murabaha for us. These are similar to what Brother Osama from Standard Chartered Bank presented. I can share with you the structure. You can share it with the wider people as part of the paper, which you may have already covered as well. With very little variations, we have covered those. So we probably will apply both of them or one of them, subject to the standard 59 of AUFI as well, because there is discussion going on in UAE at the moment with the higher Sharia board, the National Sharia board here. So subject to that as well, we will be adopting those. On the ijara, I had one more thing in mind. What Brother Osama mentioned, there is a very important element there, that the rate will be mentioned on daily basis on a website. Many banks may not be able to use this method, especially if they have very little Islamic activities or a number of transactions, where they may not only be able to adopt publishing the rates on daily basis on their website, because this is important to eliminate the element of gharar, in ijara. Even some scholars before were not agreeing the existing structure, like Sheikh Nazir Hamad, from my experience working with him, he was objecting on the existing mechanism of sending rental notices as well, seeing gharar there in these ijara contracts, because you have to agree the rent for every period. Now that you cannot agree the rental upfront, and you have to calculate it on daily basis, if you are not able to notify the customer so the customer can agree on this, it will be an issue. That's why Brother Osama mentioned that the daily rate will be mentioned on the website, where the customer, if he's interested, he can go see and object, and if he objects on that, then the purchase undertaking will kick in and the transaction will come to an end. My idea was, instead of one more solution can be that we can convert the backward looking benchmark into a forward looking by basically charging the rental of the first period for the second, and then dividing the last period into two to recover two rentals. I know it is very difficult to explain everything at the moment, given that we are at the end of this workshop and we don't have much time, but I can share that in more details with you, Brother Ijlal, and you can share it with others. Thank you very much.
Thank you so much, Brother Yasini. Indeed, helpful comments. And we look forward to, working, inshallah. And again, Islamic rate, the timing is of course right, but then again, we have to see the cross-border market and keeping, the Islamic finance and international market, both from the solutions perspective, documentation perspective, and also, legal and, Sharia perspective. We have to really focus on that and purpose of this meeting. So anybody else, please like to, have a short comment, please go ahead. And again, I think the chat box was good. Some replies were made and some discussion already took place. So that is also helpful. So any other, sort of somebody would like to comment, please go ahead. So generally, I think we are sort of, if there are no other comments at the moment, and, I can just see the chat box. So I think now probably if there is no further, comments, and we sort of noted, in terms of the objective, I think I can safely say that we have achieved, some sort of objective, what we wanted to do, and the roadmap for us to identify, and prioritize. I will again sort of request if people can, other who can send us the comments, their suggestion and their priorities in terms of recommendation, what is needed, both from the solution perspective, which is, I think, is critical, and also, documentation amendment, maybe, of course, accounting side, like presented, there is a huge work to be done, which I'm sure AOFI will do. And IFSB maybe, it could be risk related or maybe governance related. I'm sure that can be done also. And at the same time, we are also supportive, and I'm sure some forum will take place, whether IFM will do it or, Work Fund, like previously has done, Bahrain have organized, so that we have to continue to work on the Islamic rate and see how it can be applied. So if there nobody else has comments, and people are now, I think, also have to leave for their respective works, I really am very thankful, for all of you, for various places joining, like into about 10, 11 countries we have. which has been very helpful. And I really seek your comments to finalizing of the paper, which will be very helpful. Please do send us your comments, your recommendation, your suggestions, and we inshallah will finalize that paper, and that paper will be used for the wider market awareness also, and also inshallah for us to work, in a manner which we need to do to address the issues and challenges which are presented today. With that note, I would like to now close this consultative meeting. We look forward to, inshallah, do let us know if there is any. Of course, we would be doing certain specific maybe working group and all, subject to IIFM board approval and prioritization for 2021. And we will, inshallah, be back again. And if you like, we IIFM to organize in certain focus, discussion points. We'll be happy to, do that with your support, inshallah. We can make industry more robust. Jazakallah khair. Assalamu alaikum wa rahmatullahi wa barakatuhu. I just can see one last comment if there is something. Yes, so I think these comments now what we are seeing, although generally people are not really, commenting. Maybe I said strongly in terms of, discussion, and also, you're not coming forward to present your view. But their discussion, at the chat box, I can see at the moment in terms of existing financial content. Of course, these are the things which we are very mindful, and these are the things which are highlighted and will be highlighted also in the paper, and these are very relevant to IIFM, what we do in the financial contracts. And there are legal issues with that, not only Sharia issues as well. So this is something which needs to be done. And I think one thing which was mentioned also, that there is accounting issues to be addressed, that it leads to that. So that is also to be done. So we have a huge task, but it's not impossible. We can inshallah achieve for international market, and the other, which was also very relevant, that timing is good, and inshallah sincerely pray and hope that we can achieve the other objective also, which will be discussed at other forum, inshallah, in the near future. If there is no other comment, we can safely now, inshallah, go ahead with our respective, work, or we can just say that, like Dr. Azlan can, inshallah, his name is appearing differently, I can see. So maybe registration, we made some mistake. So it's not from Central Bank of Sudan, but it's for Dr. Azlan. So we can relax, and inshallah, we will be, inshallah, in touch again soon. Jazakallah khair. Assalamu alaikum wa rahmatullahi wa barakatuhu.
Wa alaikum assalam wa
Alaikum assalam wa
rahmatullahi wa barakatuh.
rahmatullah.